investment, and Renault owning 30% of Nissan, of course. But now we're heading towards the Open, Anna.
Yeah, absolutely. So going towards the Open might be a slightly slower start. In fact, we've had a few slow starts, haven't we? We get a slow start when there's nothing to trade on, and we get a slow start when there's too much to trade on. That was certainly, the latter of those was certainly the case in earlier days this week. The CAC and the DAX took some time to open as a result of just a lot of news flow being processed by everyone, and no doubt a lot of trades going through. Today we've got a swifter start then. The FTSE 100 is pretty flat, though. The IBEX over in Spain down by 0.1%, waiting for the CAC to open, waiting for the DAX to open. A little bit of corporate reporting, the likes of Air Liquide, for example. We'll certainly keep an eye on the UK retailers that you flagged, Lizzie. The CAC 40 is actually up by 0.2%. So we've got a bit of a mixed picture, slight upward bias to what we're seeing across European equity markets, picking up a little on what we saw in the US yesterday, maybe the latter day recovery on US stocks. Perhaps then, Lizzie, just feeding in a little bit. Still waiting for the DAX to open, but I wonder what you see in the sector picture.
Well, if we break it down, we've got about 3/4 of sectors in positive territory. So chemicals leading the gains this morning, up 1.3%. Construction and manufacturing just behind, up 0.4%. And travel and leisure just behind that, about the same. But bottom of the basket, we have media, energy, utilities, all in the red this morning. Now, I did mention that we should be keeping an eye on retail, some of those names in the UK after the data there. We have Currys up 2.4%. Kingfisher in the green as well, but Dunelm in the negative, as is Freighters Group. So a mixed read of these, that beat on retail sales numbers this morning when it comes to retail.
Yeah, absolutely. The one sector that jumps out to me is the chemical sector, moving really much higher this morning. And I said we didn't have much corporate reporting, but we did have at least one. Air Liquide reported numbers, and that stock is up by 3%, in fact, this morning. The company giving their numbers to the market, full-year recurring operating income coming in pretty much in line with expectations, but something about what they've said this morning has lifted the stock. In terms of the wider picture for European equity markets and some of the movers in focus, then we have to the upside, Standard Chartered. So that's one of the stocks that goes higher this morning and helps to contribute some upside to markets. So better than expected numbers coming through there, and also a buyback for investors, so perhaps that going down well.
Yeah, interesting, given that you had the drop in Asia trading for Stan Chart, but actually European traders reading it positively. Relics shares not doing so well either. They are at the bottom of the basket when it comes to media, which, as I say, is the worst performing sector this morning. So Relic shares down 0.7%.
Yeah, and interesting to see Process gaining, up by 2.3%. We talked about China, the positivity coming through there. Lizzie, we talked about the Alibaba story and the way that's lifted Chinese tech stocks. Well, Process, big owner of Tencent, of course, and so whenever Tencent goes higher, we often see that Process does the same. And let's get into a wider conversation then about European stocks. Kieran Nandra joins us, Head of Equities at Jupiter Asset Management, around the desk with us this Friday. Kieran, nice to have you with us. Thank you for coming in. So 21st of February, and we have European stocks. You know, they're trying to put in a good show this morning, up by 0.2%, but a bit of a struggle. It's been a good start to the year for European stocks up to this week. It's been a bit more of a struggle this week. Asian stocks have also had a good start to the year, and they're continuing to do so. I wonder, when you look around the world, when you look at equity markets around the world, where are you looking to for the best gains now?
So I still think that despite what Europe has done year to date, there's still a lot more that Europe has to offer in terms of just that kind of that market appreciation. So maybe just taking a step back, what we've seen with valuations, historically Europe and the US have traded at pretty similar peg valuations. But where that valuation discount has really opened up has been within Europe. Now, some of that has been linked into US exceptionalism. And I think what we're really seeing now is just a broadening out of the opportunity set. And investors just looking to perhaps diversify a bit more away from that kind of high levels of market concentration and just trying to get a bit of more of an exposure to other growth pockets, which I think Europe is still very much offering.
Okay, so those are some of the sort of top-down thoughts, perhaps. But actually, I think you tackle these things bottom-up, don't you?
Yes.
So what are the key themes that you're looking at? If you are tempted by European stocks at this point, maybe the valuations are compelling. What are the key areas, key focus areas for you?
Yeah. So historically, if you think about where you found value in Europe, it's been much more in those kind of quality growth types of names. And I think as we're kind of seeing that broadening out of sectors and styles, I think financials are still an area that we find particularly interesting. Some of that is just due to perhaps a kind of a more normalized interest rate environment, which typically is really good for European financials. And in fact, when we're looking at earnings, just anecdotally, what's been released so far, it's been quite surprising how financials have actually managed to, I would say, surprise on the upside. That's not just driven by the top lines, but it's also been driven by perhaps better earnings quality, better loan loss provisions as well, which has been pretty positive. I think another sector that we're thinking is actually quite interesting at the moment is just on the cyclical side as well. So especially kind of cyclical chemicals. If you think that energy prices might be coming down, so that's also one area that's been of interest. And then really finally, I would say things like data centers as well.
Okay.
Well, just as we've been speaking, the DAX has opened. It's flat to the upside, so barely anything happening over in Germany. But if I can ask you, Kieran, about the German election, where do you think it's going to leave German equities?
I think so. That's a great question. So generally, Europe and globally, we've had so many elections, and that's led to a level of uncertainty, which hasn't been particularly helpful. So I think almost regardless of what the outcome is, I think just having a level of certainty is going to be very positive for markets generally. I think that's just having that. Where we've seen that on the back of most elections, it's just been that certainty premium, just because the level of uncertainty at the moment is really, really high.
I mean, that's a theme that keeps coming up when, in the context of tariffs. Is it more the tariff uncertainty or the tariffs themselves that are the issue for equities?
That's a great, So on our side, we see it as just being that tariff uncertainty, because there is so much. Is it the bark? Is it the bite? Which is problematic, and we saw just recently when we came to kind of Mexico, for example, one thing was announced and then very quickly it was just kind of either kind of rolled back or kind of adjusted, I would say. So again, when we're looking at when we're having conversations with companies, the types of companies that we're looking to invest in are those that maybe have the nimbleness and the ability just to kind of move production sites from one country to another. And I think that, again, it's that uncertainty, just having those companies that can adjust to that environment.
So agility and an ability to adapt is important then, Kieran. I mean, that takes us to the Trump White House, President Trump and his White House agenda. And I wonder, we're hearing some talk of some pretty big suggestions, an appetite for risk perhaps from the White House that maybe we haven't seen for some time. So some in the markets are talking about whether we might see a new Mar-a-Lago Accord, which would be like a Plaza Accord, devaluing the dollar. And I just wonder, in terms of the risks that you think about and things that are out there, do you stress test your portfolios to some really pretty extreme outcomes? Do you have to increasingly do that as politicians of a populist backdrop seem quite comfortable with taking quite big risk?
Absolutely. So we are absolutely flexing all of our portfolios just to look at those very extreme scenarios, and bearing in mind that we absolutely are able to flex portfolios, and so you see where we're overweight and underweights in terms of our factor exposures. That's a really clear way where we're able to kind of really isolate what the impact might be. But I think it's also really important to bear in mind that some of those second-order impacts are also something that it's actually quite difficult to model for. So that comes back to that original point, which is, why the nimbleness is really important that we're looking for when we're looking to invest in companies.
Well, when you contrast that pro-business offering of Donald Trump, the pro-growth offering with the pro-growth offering of the UK, and then when you hear the likes of Glencore's CEO talking about considering moving away from their London listing, I wonder if you think that kind of trend is going to continue, this shift away from London?
So if you talk to a number of companies, what we're really focused on is just the pipeline for listings in the UK, and that pipeline is actually increasing. Okay. So the reasons for perhaps that lack of interest that has been in London stock markets has really been long-term structural decline of pension funds not investing as much in the UK equities. And I think what's really important to remember today is that we've got much more of a kind of pro-growth and pro-change agenda from politicians that perhaps wasn't the case before. I think that's a big difference. And I think what we really just need to do is remember that the UK remains an incredibly attractive place for companies to invest. It's just trying to stem that liquidity drain that we're seeing. And I think once we're able to stem that, I think that'll be a game changer.
And you see more listings then coming to the London market, Kieran?
So the pipeline that we're hearing about is much better than it was this time last year. So I think a lot of the reforms that have been spoken about, which maybe haven't been implemented because of that lack of political stability, that's now changing. So we're hearing a lot less that companies are finding it difficult to cope with the listing rules. So I think that's the kind of a topic that was very much in the rearview mirror. And I think now what's really important is that we get an injection of some of those the growth impetus and just having flows coming back into the market.
They're not all banks and energy companies or oil companies.
No, exactly. No, yeah. That's very true. So I think AIM is clearly very, very important.
Yeah.
But like specifically when you're talking to those companies, what is it that they want from the Chancellor to persuade them to list here?
I think the listing rules have actually improved. I think what we need to see is just more of that flow coming back into the market. So we've had a couple of topics that have come up, which I think are very important, which is things like stamp duty on share transactions. It's even trying to maybe shift the agenda from ISAs, from cash ISAs into more stocks and shares. I think those are the kind of the things that we'd like to see more on.
You mentioned a few themes that you were investing around, Kieran, earlier. One of them was cyclicals, and one of them was data centres. The energy transition, then, where do you see the best opportunities for that? Because there are different parts of the supply chain that you can pick to get exposure.
Yeah. So I think still very much what we call like the picks and shovels is going to continue to be important. And despite what's happened with NZAM, I think that is still very much a capex trend that we see continuing, maybe to a lesser extent than before, but we still see that kind of evolving. And then when it comes to that's obviously the energy transition that kind of taps into in capex, just in terms of old infrastructure as well. But even what we're seeing with AI, I think that those second-order impacts will be something that we still continue to be interested in.
Yeah, some of those capex trends really worth watching then, and productivity. Thank you very much, Kieran. Thanks for coming in. Kieran Nandra, Head of Equities at Jupiter Asset Management. And that thought about data centres takes us nicely into at least one of our core six. Let's have a look. Schneider Electric trading higher by 1%. Makes me think of that when I think about data centres. We've got Ferrari actually on the back foot, but elsewhere, European equity markets then, at least as far as the core six are concerned, holding their heads above water pretty strongly. Stock 600 more broadly is up by just 0.3%. Let's get to Joe Easton. He's got some individual stocks on the move. Joe.
So one of the top performers this morning, Anna, is Stanchart. We're up 5% at the moment for Stanchart in London. Now, bear in mind, this stock was significantly lower when I got to my desk this morning, and I've had to figure out why this has actually reversed that move in the London trading. It does look like that buyback is making up for a bit of disappointment on the write-downs in one of their software assets. That's what analysts are saying today, so a really good jump. And the CEO's got a 46% pay rise, so everyone's going home happy from that one today. Then in terms of Air Liquide, big debate is whether that's a QA or a CA. We're going to go with a CA rather than Air Liquide. Now that one is up 3.6%. The order's better than expected, and the margin's actually rising by a full percentage point for the company. It's industrial chemicals and gases, and that's lifting the chemical sector today, really doing all the lifting in that sector on its own for the French company. Then we've got building materials. Kingspan out in Ireland getting its biggest gain in around 18 months. It's up 10%. That was around the third best performer on the Stock 600. in the opening of trading. EBITDA much better than expected. It's a supply of materials used in the building sector, building walls, that kind of thing. So it's getting a good boost today. Then in terms of Alton, this one was actually another one that's been keeping us busy because it was called lower and it's now up 14%. This is a software company. It's in the aerospace sector mostly. They supply into that business. We're up 14% following earnings, a big jump, a reversal. Some of those early calls we got from the market makers early this morning. The biggest gain in 13 years, according to our headlines there. Then on your broker moves, Airbus is downgraded. Jefferies had been a buyer of that stock for 2 years. Did get those weak results out of the company yesterday and disappointment on the dividend. That's what Airbus was. The one that Jeffrey said that about yesterday, to get my wording right there. So we're coming down a bit on that one. And then finally, Repsol, another one that has a downgrade today. This is over at UBS. They say the positivity is priced in at the Spanish energy company. Again, it's post-results. Analysts updating their ratings. Repsol down 1% in Madrid this morning.
OK, Joe Easton from our equities team, we thank you. You did mention some of those UK retail names, and they are mostly in the green now off the back of that retail sales number earlier that we saw, and actually that increase driven by food stores, the biggest rise since March 2020. We also got the GfK consumer numbers out earlier today, and actually that's firmly still in negative territory, even though all the metrics within the report have improved for February. But we're also going to get some data out of France in just a few moments. The latest PMI numbers, the expectation for a tiny bit of improvement across the board, though still in contraction territory. And indeed, we are seeing on manufacturing an increase from 45 to a reading of 45.5. That a beat. On services, 48.2 is where we were previously in February, 44.5. So a fall there way below the estimate of 48.9. And the composite reading also a miss, Anna.
And look at that euro drop. So the euro drops on the French PMI data, down by 0.3%. That services number really coming in weaker than expected. We are going to get the German number, aren't we? Which, with the German election looming, of course, is very worth thinking about. So we're going to get that in around 15 minutes' time. But really underwhelming services numbers, aren't they? And this is an economy that's had, well, a political backdrop we talked about many times, had a lot of uncertainty to it, had a bit more certainty of late, but still the services side struggles there. Yeah,
the lowest since 2023 on that services number. And so, as you say, a real reaction when it comes to euro dollar, down 0.25% at a 104 handle. You can see it there.
Yeah, absolutely. So that's the weakness in France. We will certainly focus in on these PMI data as it comes out from Germany. That's in around 15 minutes' time. Coming up, shares at Standard Chartered soaring after reporting plans to hand back $1.5 billion more to shareholders. We'll bring you highlights from my conversation with the CFO next. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trade-in with The Close. Weekdays on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Listen carefully. Can you hear the rhythm?
not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Welcome back to the opening trade. We're nearly 20 minutes into today's session, and we do have your stock 600 up 0.2%. The DAX just slightly to the downside. But really, if we look to the bond story, we just had the French PMI data dropping, and a big surprise when it came to the services number, a miss there, and that really changing the outlook for the ECB's rate bets. So now traders have added to those bets. They see 80 basis points more easing this year, and you've seen bunts extending their gain off the back of these numbers as well. The 10-year yield lower 4 basis points at 2.49%. Yields on the 10-year lower 3 basis points at 3.2% as well. So we keep an eye on that, as well as the euro drop. 104 is where we trade at the moment. But just getting back to the equity story, interesting to see as well this disparity when it comes to Standard Chartered earnings and the reaction in the UK European session, 4.7% of a gain compared to what we saw in the Asian session, Anna. Traders not so impressed.
Right, yes, absolutely. So the share price is going higher here in Europe, and it does seem as if some are citing the buyback as being one of the reasons for that. Let's check in on Standard Chartered shares. There you see on the screen up by 4.7%. The bank reported fourth quarter earnings that beat estimates, and they announced, of course, an additional $1.5 billion share buyback. I spoke earlier to the CFO, Diego De Giorgi.
First of all, let's remember that in terms of contribution to the top line, our net interest income contributes about 50%, and our non-net interest income contributes about another 50%. Non-net interest income has very strong engines of growth, up 20% last year, as we have just discussed. And in terms of net interest income, we have been building up our hedges, de-risking the delivery of net interest income, and I think that positions us well for this slightly more uncertain world.
Okay, so let's turn to the other part of that, of the income stream, and away from net interest margin and the other areas. One of the areas I want to ask you about is global markets and what you've managed to achieve there in the global markets business, getting a boost from some of the volatility in markets. It seems traders doing well on that. And that's been a story across Wall Street, across lots of the banking sector. Thing is that sustainable in any way? Do you have any visibility on whether that kind of performance is sustainable?
So I think it's sustainable for us. And the reason is that our markets business, as we often like to point out, is a peculiar type of market business. Because we are a giant connector bank, really 75% of what we do in markets is helping our clients manage their exposures to foreign currency, interest rates, and other risks. That is very recurrent activity. When volatility then spikes, we add to it performance in helping them take advantage of those market dislocations. But the delivery of our financial markets numbers is highly de-risked once again by this attractive complexion of the business, and it's business that, by the way, grows well. We pointed out at Q3 at our last set of results that this part of the business grows at almost 10% per annum, and it's been doing so for 5 years.
Let's get analysis from Bloomberg's Jenny Serrain joins us now. And Jenny, he was putting the focus on some of those fee-generating businesses rather than the net interest margin-reliant ones. And one of those areas is the markets business. He talked about that. A really big growth there, 46% higher in the quarter. I was talking about volatility in markets driving that. Is that the whole story there? What's happening?
So Standard Chartered is an interesting bank on this front because really it is trading, but it's actually trading for corporate clients rather than the traditional Wall Street clients like hedge funds or asset managers that we would think of. And these are clients that, you know, the French PMI data that you guys were just talking about, these are clients that pay intense attention to that because that is really what's at play in their treasury books. And so Standard Chartered is in there with them, kind of helping them position around these big swings. And that's why I think they're kind of, through good and bad, able to see a really strong generation of revenue from this business because it's not as volatile as maybe, you know, hedge funds putting on and putting off positions or asset managers kind of shifting big ways in and out of equities. And so, yeah, I think it's interesting. It's a real strong generator of revenue for them and then helps in the times where, you know, you might be looking out to lower interest rates to come.
The other thing that Diego said to Anna is that there's more to do still on the stock price. I mean, what are UK investors in general actually looking for from the UK banks?
Yeah, I think it's really interesting. Standard Chartered is our last big UK bank, and something we heard kind of consistently throughout this earnings season was that the Labour government really just is kind of in need of giving some assurances on the regulatory front. And so you've heard so much from that. I think in the interview this morning, Diego was talking about the bonus cap getting removed and how that was a really big win for them and something that was really important to being able to keep talent, which obviously then translates to better performance from the bank. So I think that's the big thing for investors right now is kind of getting an understanding of the regulatory environment and probably kind of one of the last remaining questions that they have about
Jenny, thank you very much. Bloomberg's Jenny Serrain on Standard Chartered. That stock price going higher on the buyback this morning. Coming up on the programme, we turn our attention to Germany. We will break down the latest PMI data and ask author John Kampfner how the election has shaped the political and policy debate. But first, the far right has loomed large over the election campaign. Oliver Crook reports.
Political parties have successfully blocked the far right from power ever since the end of the Second World War. But ahead of the election, how strong is Germany's so-called firewall? In January, conservative favorite for the Chancellery, Friedrich Merz, attempted a hardline overhaul of migration policy, and the motion received backing from the Alternative for Deutschland, breaking with that political tradition and sparking protests across the country. The anti-Euro and anti-immigration AfD first won seats in the national parliament back in 2017, a rebuke to Merkel's open-door refugee policy. 7 years later, as immigration climbed the list of concerns and economic stagnation set in, the AfD would win its first ever state election.
Germany is not in a very good state. We have the highest energy prices worldwide. We are in the middle of a migration crisis.
AfD leader Alice Weidel is running on a policy of mass deportation. It's a message that's also found favor across the Atlantic.
No voter on this continent went to the ballot box to open the floodgates to millions of unvetted immigrants.
While the AfD support for Merz's border bill did little to hurt him in the polls, he'll need at least one coalition partner for a majority.
We will not take these right-wing populists into the government which is led by me. Never.
But no matter what mainstream politicians say, the far right has shifted the political debate in Germany. And as for Weidel, she was all too ready to declare that the firewall had fallen. Oliver Crook, Bloomberg, Berlin.
Why does this business model work? Because it's virgin space. It's never been done before, and it'll never be done again. When you step back and you look at something that's been golf through institutions, has been the way it has been for 53 years without change, In 1993, I stepped back and said, okay, this is not right. It's doing the same old Groundhog Day. Everything's the same. Players are a pass-through entity. They're not getting any equity built in their day. Once they're done playing, they're out. I thought, that's just not right. When you have to build a sustainable model, you need to have these players, these famous, the world best, the best of the best. You need to give them equity into the future. You need to give them a vision of where they need to go and how they're going to get there.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
This is the opening trade. We're 30 minutes into today's session. We've already had the French PMI numbers, euro down, bonds up off the back of that services surprise. And we now have the German numbers as well. So German services PMI coming in bang, well, just a little shy of the estimate. So 52.2, the estimate was for 52.5. Manufacturing 46.1, so a beat actually out of Germany on manufacturing. The estimate was for 45.5, and the composite coming in at 51. The estimate was for 50.8. So this is interesting ahead of the German election, Anna, of course, a snapshot into the economy there.
Yes, and there was a temptation to pair losses on the euro as a result of that data as it dropped because, yeah, the services story not as bleak as in France. It's well above 50, so it's in expansion territory on services. But then a reminder on the manufacturing side that we're still in contraction territory on German manufacturing, and that number, yes, it's better than expected, but it is still with a 40 handle, 46.1 as you describe. And so the euro did try and push a little higher, but didn't get very far, did it? 104.77 as the market asks questions about, okay, so how many rate cuts are we going to get this year from the ECB?
Well, just on the French number, I saw a note from Tariq Kamal Chowdhury over at Hamburg Commercial Bank saying this is a recession with no end in sight, so a much bleaker picture out of France than Germany.
Well, that's a gloomy backdrop to go to the polls with, isn't it? Let's put that PMI data into context ahead of the German election on Sunday. Bloomberg's Oliver Crook joins us now from the Chancellery in Berlin. Ollie, that PMI reading then, slightly better than expected, but still below 50 on manufacturing. The services data, at least, coming in and not freaking the markets out quite like the French data did. How is this growth story, or lack of it, though, playing into the election?
Yeah, I mean, I think it's the fundamental mood music, Anna, as you were just mentioning, to basically the last few years, the post sort of pandemic times and the post-invasion of Ukraine by Russia and the energy crisis that ensued for Germany. And that's really been the story here for Germany economically. I mean, we've talked about these sort of years of contraction in manufacturing PMI. I mean, listen, 46.1 is a beat. It is, though, still firmly deeply in contraction territory for German manufacturing PMI. The last time you got a positive print on German manufacturing PMI, you've got to reach back to June of 2022. So that is for how long we've been talking about sort of severe contraction within the sort of German manufacturing space. And that was fine on paper for a while, but it's really last year that we started to have the rubber hit the road and what that meant for job cuts. We know about Volkswagen, the long negotiations that have been going on with the unions and the tens of thousands of jobs and sort of salary reductions that are going to be going on there. We got it out of yesterday, out of Mercedes-Benz. You know, even the sort of luxury automakers are not spared. They're now doing a cost-cutting plan across the business, 10% 4% across the business is really sort of the headline there. So this is sort of the cycle, and we're not really, I don't think, at the bottom yet. The people that I talk to, the economists, in terms of job cuts, is we may not have seen the end of it, and that is precisely what is going on in everybody's mind heading into the sort of the booth this weekend on Sunday, where they're going to elect a new government and eventually a new chancellor who will sit in the chancellery here behind me.
Well, before they do, Ollie, how are the polls looking before we get to the election?
Yeah, Lizzie, as we've talked about a lot throughout this sort of election campaign, and again, this is a sort of process that began on November the 5th with the sort of pulling of the plug on the coalition, the collapse of the German government, the same day that Trump was elected president of the United States, and that has been sort of the long sort of drawn up, we call it a snap election. It's taken quite a while to get it going, but that is what we're leading to into the weekend. And what has been a sort of main feature of this are two things. One, the AfD, the Alternative for Deutschland, the far right, is a real protagonist in the political story in Germany, really for the first time at the federal level. This is the first time they've ever put up a chancellor candidate, and they're going to pull in the second place about 20%. But really, it's been Friedrich Merz and the CDU, Merkel's traditional party here in Germany, that has been leading with 30% of the vote. If you look back sort of historically and where Scholz came in, he only won about 25% of the vote last time, which is why he had to hobble together that three-way coalition. Heading into the vote on Sunday, I think that most market participants, at least as far as the market is concerned, what they would like to see is the small parties to get under 5%, to get knocked out of the Bundestag, have a nice strong majority where you could make either a sort of two-party coalition to really get things moving here in Germany, because a large complaint has been that while there's been sort of all of this sort of economic gloom, that there's been an impossible way to get a sort of cohesive and coherent economic policy. So something is really better than nothing. And the worst case scenario would be, again, a sort of fractured political system where you have a very sort of ugly coalition negotiation that goes on for months and months and months while you're staring down the barrel of tariffs potentially from the United States.
Okay, we wait for those ugly negotiations potentially. Bloomberg's Oliver Crook, we thank you out of Berlin. Well, let's stick with that German election theme and discuss whether it actually can bring stability back to Europe's biggest economy. We're joined now by John Kampfner, author of In Search of Berlin, the story of Europe's most important city. Good to talk to you, John. You also wrote a book called Why the Germans Do It Better, Notes from a Grown-Up Country. I wonder if you think, given all that chaos Ollie was just talking about, it still is a grown-up country.
Yes, good morning. I get asked that question all so often, 2 or 3 times a week, sort of, do I still stand by that thesis? The answer is, well, that was 5 years ago and things were looking different. I still think there are some fundamentals about the way German society is structured that may, just may, see it through these incredibly turbulent times. All the tendencies that you have been setting out in your introductory packages and in Ollie's two-way just then are consistent with everything that is going on pretty much everywhere else in the Western world, where you have populist parties either running things, in the case of the United States, with spectacular extremism, or in Europe, or they're knocking on the door. So there's nothing particularly German about what is going on here. People look at Germany in a different way because of its war history. But this is, in all respects, an absolutely crucial time here for this country. Not only the domestic political agenda, you've been talking about the economic downturn, 2 years of recession this year, heading that way as well. The migration issue consistently being number 1 or number 2 on people's agendas and being very, very heated. But also the specter of Donald Trump looms over everything here in Germany. His new love-in with Vladimir Putin is really freaking people out. Germans had 3 years ago been told by the outgoing Chancellor, Olaf Scholz, to prepare for a more muscular defense policy in defense of Ukraine. And now they're being told by what Germany has always believed to be its best friend and partner, the United States, that actually Putin is the person we should be dealing with and Zelensky is a dictator. So it's just incredibly confused here and upsetting for so many people.
Yeah, I mean, of course, it's not unique to Germany, but the tone, surely you would agree, is nowhere near as polite as previous German elections. Do you think that this coalition chaos is the new normal in Germany?
So on the language, absolutely. It has been quite startling to watch the way the old coalition collapsed in acrimony and pretty much also the narcissism of small difference. This was about pretty mediocre egos fighting it out over not very much. And as a result, the government collapsed. If that doesn't undermine people's confidence in the political process, I don't know what does. The election campaign, the debates have been pretty heated as well. I personally don't mind that. I think fiery politics, particularly if it's on issues rather than individuals, is a good thing. What this country needs most of all, as Oliver was talking about when looking at the opinion polls, is strong leadership. Now, Olaf Scholz was, in this regard, absolutely abject. He showed no leadership at all. Germany stuttered for 4 years. I personally don't think the fact of there being 3 parties in government, it surely doesn't help. But I didn't see that as being the reason things were went so badly wrong. I saw a failure of leadership in Scholz, who didn't just simply say, we're going this way, guys. Are you going to collapse my government or not? And I think Merz is going to do that.
John, can I ask you about the rise of the AfD? Clearly a big theme. It has been in regional politics in Germany and now increasingly on the federal stage. We've seen the CDU, CSU flirt with some kind of vote borrowing from the AfD in at least one area of policy. We spoke to a professor earlier in the programme who said, look, the firewall is going to stay for now, but it will go eventually. I know you've looked at Austria and the example set there as well. Do you think, to what degree do you think a CDU, CSU-led government will cooperate in some way with the AfD?
The firewall is still there, but it is incredibly fragile. Friedrich Merz continues to say that he wasn't looking for AfD votes. He was simply trying to put down a marker to say we need much tougher migration legislation. I beg the mainstream parties to join me. If they don't, then it's out of my hands. Most people think that was pretty disingenuous. I think he was struck by the extent of the pushback he received. Demonstrations outside his party offices. It absolutely shook Germany to the core. That sense of bewilderment was as nothing compared to J.D. Vance's speech a few weeks later at the Munich Security Conference, attacking German democracy and very publicly embracing the AfD, something that Elon Musk had already done. And as a result of all of this, I think a more chastened, a more sober, at least I hope, Merz has emerged from this, in which he won't flirt with the AfD, but he's also saying to the Social Democrats and the Greens, and it could be both parties he has to go into coalition with, look, you guys, don't sit on the fence, don't make me problems, join this government, toughen up a bit, and come with me on this journey, because the alternative, either now or in 5 years' time, could be the AfD.
John, I wonder what you make of Elon Musk and J.D. Vance getting involved in German politics. And I'm trying to cast this forward because we can all see the impact it has had and the headlines it created in Munich, as you say, and when Musk addressed the AfD conference. We can see that in the rearview mirror. But looking ahead, we could be going into a protracted period of coalition negotiation, do you think, maybe? And should we expect US voices to be quite loud in that?
I'm sure we will, given the amount of things that Trump, Musk, and the others say on a daily basis about so many things. I'm pretty sure we're going to hear some aggressive, disparaging remarks about Germany. I hope very much, and Merz has asked the other party leaders to form not just a robust coalition, but to form it quickly. In 2021, it took 3 months. The process was ridiculous. And at that time, that was before Putin had invaded Ukraine, things were a little bit, or a fair amount, calmer. There is no calm here. There is an absolute sense of being on the brink here. So the impulse to cut a deal, to form a government quickly, will be strong. Now, all of this, by the way, is predicated on our assumption that the opinion polls are accurate. And German pollsters do have a pretty good track record of calling it right, plus or minus 2 points, which is the usual margin of error. And what is really weird is that since Scholz collapsed his own government in November, the polls have barely moved on for anybody, up or down a little bit. given the extraordinary events within the country, terror attacks, fights in Parliament, and then the first month of the Trump government, it seems really quite bewildering that the polls haven't moved at all.
John, you talked about how things could look very different for the AfD in a few years' time. I wonder, just drawing on your British perspective, is the SPD in terminal decline, or do you think that it could stage a turnaround in the way that the UK Labour Party did post the 2019 election defeat?
Well, actually, I would turn it around once more and say that if the Keir Starmer government in the UK, which has been stumbling along, really, since it won a huge majority in July last year and pretty much had a tailwind and could have got on with a pretty active agenda and has stumbled at every step of the way. Its poll ratings are extremely low. A recent poll put the far-right Reform Party in just ahead of the Conservatives and Labour, a historic poll that. So I think you have a possibility that Britain and Germany copying each other in the other regard, in the regard of the far right, same as in France with Marine Le Pen's RN. And you have the possibility, all of them, aided and abetted both by Vladimir Putin and by Donald Trump. You have a pretty spectacular challenge now on mainstream parties of the conservative Christian democracy school and of the Labour Social Democratic school and the Liberals in between.
John, thank you very much for joining us. Good to get your perspective on Germany and beyond. John Kampfner, author of In Search of Berlin. We will bring you all the news, analysis and market moves as we continue to build up to the German election, including, of course, a special programme when polls close. That's on Sunday. That broadcast live from Berlin. Coming up, the US Treasury Secretary doubles down on Donald Trump's criticism of the Ukrainian president. We'll have more from Scott Bessent's interview with Bloomberg Surveillance next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Happy Friday, everyone. 8:48 a.m. in London, and I want to take you to one of our top interviews now. Speaking on Bloomberg Surveillance, the U.S. Treasury Secretary Scott Bessent has doubled down on U.S. criticism of the Ukrainian President Volodymyr Zelensky.
I think President Zelensky, unfortunately, escalated and has put some daylight between.
How did he escalate?
A lot of his remarks in Munich, I thought were inappropriate. President Zelensky, when I met with him, assured me that he'd be signing the minerals deal in Munich. He has not. And look, the real purpose here, and I think it's turned into kind of this media circus, that President Trump had a very elegant plan, and it was bring the Ukrainians closer to the U.S. Let's do this economic deal. And even Karl Rove in the Wall Street Journal this morning approves of it, that the U.S., with greater economic interest in Ukraine, provides a security shield. So the sequencing of what was going to happen was bring the Ukrainians closer to the U.S. Through economic ties, convince the American people and the American public, get them on side, and then tell the Russians, go to the negotiating table with a very fulsome message that if we need to, we will take sanctions up.
Well, what about tapping the Russian frozen assets, some $300 billion? Would you force your European counterparts to not just have them frozen, but actually tap them? Trump talks about repaying the American taxpayer. Shouldn't Russia be a part of that?
Well, what's happening now is they are being tapped. So the returns from
the interest,
the returns from the freezed asset pile is going to pay the Europeans. You know, what's very important to understand here is that everything the U.S. has done to date, the American people, the American taxpayer, is grants. The Europeans, roughly half of what they've done are loans, and the runoff from the frozen assets is being used to repay European loans.
Have you communicated that to the Europeans, that you're upset with them?
What's that?
Have you communicated to the Europeans that you're upset with them?
I think Vice President Vance did a pretty good job in Munich.
Do you think they understand that the United States is running a deficit of north of 6%, close to 7%, and that the budget for defense is north of $800 billion? Do you think they understand the gravity of the moment in the United States, the U.S. perspective?
Look, I think that they understand that President Trump, during his first term, this term, Vice President Vance, and the entire security apparatus have told them that many of the countries are deficient in their NATO spending, and they need to come up.
Great to see Scott Bessent back round that table without his investor hat on, and now with his US Treasury Secretary hat on. An interview on Bloomberg Surveillance.
Now, let's have a linking moment between this and our next item. The South African President Cyril Ramaphosa has downplayed a rift with the US. There seem to be plenty of those to go around after the Secretary of State Marco Rubio snubbed a meeting of G20 foreign ministers taking place in Johannesburg. The US Treasury Secretary Scott Bessent has also said he won't be attending a meeting of G20 finance ministers that takes place next week. Let's get more details. Bloomberg's Jennifer Sabasaja joins us now from the event in Soweto. Jen, good morning. So what has Cyril Ramaphosa been saying?
You know, Anna, as you were just mentioning there, a lot of nations have really had quite a few weeks and a few months, including South Africa. But we've heard from President Ramaphosa. He opened up this G20 foreign ministers meeting yesterday, at least trying to not let a lot of the noise that we have been hearing overshadow his agenda going into this G20 presidency. And a lot of that has to do with addressing a lot of the concerns for the African countries and the global South, but also trying to promote multilateralism and global reform of some of these multilateral institutions. Here's part of what he said yesterday.
we continue to call for the UN Security Council, the multilateral trading system, and the international financial architecture to be realigned, to be reformed, to make them more representative, more agile, and more responsive to today's global realities.
And Anna, we've heard a lot of that sentiment echoed by many of the leaders who are here today. There's about 35 approximately foreign ministers who have been meeting between yesterday and today, trying to see if they can find some consensus on a lot of the geopolitical issues that we talk about on the show day in, day out, and see what the G20, if anything, can do to address some of them. And what we've heard from President Ramaphosa is he does not deny the fact that there is a lack of cohesion and consensus on a number of these issues, but they're at least trying to address them. But of course, the big elephant in the room is not having the top U.S. representatives here. We do have U.S. officials, though, that are here on the ground, but there is a noticeable absence of the U.S., but still they're trying to progress with the agenda.
And Jen, what does that US snub mean for the agenda then?
Right. You know, Lizzie, what we've heard from the president here is they're trying to say it's still business as usual from the president and from others. We should note that actually without Secretary of State Marco Rubio and Treasury Secretary Scott Bessent being here, over the past 24 hours, we have seen a number of ties between some of these member states and others forging closer relationships. Yesterday, we saw Foreign Minister Sergei Lavrov of Russia meeting with his counterpart from China. We've seen the South African foreign minister meet with his Brazilian counterpart, and we know a number of others have already started here behind me today and are continuing throughout the rest of the day. And so we're seeing a lot of existing relationships and also somewhat new relationships continue to be repaired. And I'm talking specifically about the EU and South Africa, which has been a bit fractured over the past few years about disagreements on some of the geopolitical issues we've been talking about. But we've seen the EU come to the table with South Africa, continue to pledge that their past disagreements are in the past, and hopefully they can move forward, and even pledging even more investment. And so potentially this opens the door, without the U.S., potentially this opens the door for more of those relationships to be developed, and also a number of the BRICS countries to continue to discuss some of the issues that are top of mind.
All right, Bloomberg's Jennifer Sabasaja in Johannesburg. We thank you for your coverage of that G20 foreign ministers meeting. And Africa's rocky relationship with the US under President Trump is the theme of the first episode of our new monthly show, Next Africa. That's on Friday, February the 28th.
Okay, we'll certainly look out for that. In the meantime, we have the European growth story to focus on then, Lizzie, and we're looking ahead to our weekend, of course. Let's do the growth story first. Of course, the services PMI from France came in very disappointing. That dropped the euro, and the German data didn't do anything to really recoup those losses in the euro, just a little, but not much. There we go. That's the short version of the PMI story. But the weekend dominated by fashion. Apparently.
Yes, we've already had the opening shows of London Fashion Week, and we're going to go.
In attendance?
No, but you know it brings back memories of time.
Where's your invitation?
I know. Well, we look forward to the Burberry show perhaps on Monday that will take us through to the end of the week. But there's lots of rugby. I bet that must be where Guy Johnson is. Hey?
All week? Do you think he spent all week watching rugby? I think his dreams are probably made of that stuff. Apparently, the Fête de Citron, which was on that graphic we just had there, that marks the end of winter in France. So I'm all behind that. Right. Speaking about the weekend, don't miss Bloomberg's new weekend edition. That is it for opening trade. This is Bloomberg.
is back. Join me, Shonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now. We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
The French president and the UK prime minister both set to visit Washington next week after the US sidelined Europe and Kievan talks with Russia to end the war in Ukraine. Chinese e-commerce giant Alibaba soars after reporting better than expected gains in e-commerce and cloud services buoyed by AI-related demand. Plus, will undecided voters in Germany dent the lead of conservative Friedrich Merz? We'll have full coverage and analysis of this week's election. Well, let's take a look at the European markets map. Again, a lot of the focus will be on the German polls, of course, ahead of the election. There's a lot to be said that the more number, actually, of parties in parliament, the more difficult it would rather be forming a grand coalition. This is something that Germany needs to go forward. Asian stocks led some of the gains earlier on, and it's filtering through to Europe. You can see the CAC 40 gained 0.2%. The DAX and actually the FTSE pretty much unchanged. Look, there's a lot going on, not only in terms of data. Euro area February services PMI falling to 50.7. It's still above 50, which means expansion, but it's less than expected. And then manufacturing PMI rising to 47.3. Now, a couple of things we need to really watch out for is what we heard, the latest Mar-a-Lago Accord. Unclear exactly what this means, but Jim Bianco has certainly been talking about that, and it's moving yields across the board. U.S. 10-year yield 4.4818. Well, it's not moving, but there are question marks about what this means if actually President Trump forces some holders to change their positioning. Euro dollar 104.78, and then Brent crude 75.98. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, in just over a week, there's been a dramatic shift in U.S. policy towards Ukraine. The U.S. has held talks with Russia, with both Kyiv and Europe sidelined, and President Trump turned on Volodymyr Zelensky, calling the Ukrainian president a dictator. Next week, the leaders of France and the UK will visit Washington. Now, more recently, Zelensky has said that Ukraine is ready for a security agreement with the US after a meeting with Special Envoy Keith Kellogg. Now, for more on all of this, let's bring in Bloomberg's EMEA News Director, Roz Matheson. Roz, it's been quite a week. It's been a big week since the US seems to be now siding with Russia. What's Europe's strategy getting onto the weekend?
Well, as you say, it's been a pretty extraordinary week with a lot of change and starkly so in terms of these relationships and the question being where it all goes from here. But as you said, it's also a big question for Europe. We have the leaders of France. We also have the UK Prime Minister Keir Starmer going to DC in a matter of days to talk to the US officials about their position for Europe. We're seeing a lot of conversation around Europe needing to increase its defense spending and do it quickly. A lot of promises around that regard. Yes, we need to look at our defense spending. Not a lot of tangibles so far about how exactly they're going to do that. You know, do they need to look at joint issuance of debt, for example? Do they need to cut spending in other areas of their domestic economies to do so? And so really what you need is European leaders who are going to the US next week to come with some kind of plan and a suggestion for how Europe can really show Donald Trump they're serious about taking more responsibility for their own security going forward. And they're also willing to bear some of the costs going forward on Ukraine, or more of the cost potentially than they're already been bearing. And so what does that look like in an environment where there is a ceasefire in Ukraine? What is Europe's role in that, potentially in some kind of military way, as well as the reassurance force? What are they going to spend in terms of money? And so really it's going to be about showing Donald Trump that they're serious and therefore that they need to be part of the conversation, because as you pointed out, right now Europe seems to be a little bit on the sidelines and these conversations are going on very directly, particularly between the US and Russia.
Roz, can they convince Trump or do they go at it alone? What's the strategy?
Well, there is a conversation around that. If they can't convince Donald Trump, do they need to go it alone? But even what we understand about this proposal for a reassurance force of European troops, that still requires the US military to support it and to be involved. There's just no way getting around the US having to be a part of this in some fashion, given the extent of the NATO umbrella that's been there for decades and how important that is collectively for Europe. So it's very hard to say, well, Europe can do it all on its own at this point in time. It just doesn't have the capacity militarily, fiscally, equally. It doesn't have it as well. And you've got the domestic mood in some of these countries in Europe. You can see in Eastern Europe, some leaders saying, we're not going to send troops into Ukraine. We can't do that. You've got an election, you know, just days away in Germany, a change in leadership potentially coming there. And in a lot of these countries, the environment is, you know, we support Ukraine, obviously, but we're just concerned about continuing to send vast amounts of money there, given the state of our own economy. So there's a lot of complexities there for Europe and, you know, not necessarily a whole lot of unity in approach. And so it's an open question, really, can Europe do it by itself?
Roz, over in the Middle East, of course, Israel says a body returned as part of a ceasefire agreement with Hamas was not that of a mother taken hostage with her two sons in October 2023. Now, yesterday's exchange happened as negotiations for the second stage of the ceasefire are due to start. So what do we know about what's happened and what's, again, the way forward, Roz?
Well, that is the question. You can see the extent of the upset in Israel today. These claims that the hostage that was returned was not who they thought it was going to be. And obviously, how does that lead into the further conversations? Because we're getting into the next stage of that conversation around a ceasefire in Gaza. And what does it look like in Gaza after a war? And those are even more fraught conversations than the ones we've been having. It does seem that those conversations are still due to go ahead in the coming days, but that, you know, these things are very delicate. They've been very delicate throughout. And so there's a fundamental question now about whether, you know, and what is Israel's role in this going forward. So, you know, we need to look and see how those talks eventuate in the next couple of days.
Roz, thank you so much. Bloomberg's EMEA News Director, Roz Matheson. Now, the U.S. Treasury Secretary says that bringing down energy costs and deregulation would come before any move to term out U.S. debt. In a wide-ranging interview, Scott Bessent told Bloomberg that this administration's policy will bring down inflation.
Everything that President Trump's administration is doing will be disinflationary. We're going to bring down energy costs. We're going to bring down regulation. What DOGE is doing in terms of cost cutting. And I think once the Tax Cuts and Job Act is made permanent, then, you know, we can have a revenue increase, cost decrease. And as you said, as the nation's top bond salesman, I got a pretty good story.
Let's bring in Callum Pickering, Chief Economist at Peel Hunt. Callum, as always, thank you so much for joining us. I mean, something that's really getting a lot of readership on the terminal is also this chatter about this Mar-a-Lago Accord. Now, we don't have confirmation, and frankly, it sounds very radical to warrant a second thought, but it's the idea that Donald Trump could force foreign creditors to swap their treasuries into ultra-long-term bonds to ease the country's debt burden. Again, we don't know if it's true. There's chatter. It's picking up attention. Is nothing off the table?
Nothing's off the table. I think the perspective I would take is, how do we define Donald Trump in this second term? It's so short already.
Yeah.
In almost all respects, he looks a lot like a CEO running a business. He likes deregulation, okay, that helps the bottom line. He wants tax cuts, that helps the bottom line. He mistakes trade balances for profit and loss on a corporate statement. He sees that the US has an unsustainable deficit. Okay, it's time to do a debt restructuring. So I think that you get some insight into what he might do if you think about it purely from a business sense rather than a purely political, typical presidential sense.
Because we've never seen this before. Or could it break parts of the markets in trying to get a deal done, for example, in treasuries?
I think the worry that I have about the US economy is it's had a very strong cyclical upswing, driven very narrowly by US government issuing big amounts of debt, pumping up the domestic economy, which pumps up the market. US consumers look at their 401k, they see the Nasdaq through the roof, they say, well, I don't need to save much, I spend every dollar I earn. The rest of the economy looks as weak as it does in Europe. Like, if that starts to come unstuck, the US has some problems. Since the start of the year, all the data have actually turned down, and if suddenly there's uncertainty in the treasury market, that means investors say, well, I actually demand an extra 50 basis points on a 10-year or 15-year, and then that suddenly hits discount rates in markets and consumers pull back, very quickly this comes unstuck. So I think it's a very high-wire act that he's trying to play.
But Callum, I mean, you're one of the ones that actually thinks that the world could be underestimating the risk of a U.S. recession, where a lot of the chatter is U.S. exceptionalism. So what are you looking at?
Well, almost always it's the case that sentiment is offside relative to fundamentals. In the end, that's what gives us our bulls and bear market. We like that in markets. In the US, it strikes me that sentiment is just way too high. It's going to be very difficult for the Fed to give the market a kicker if the US economy slows, because inflation is just too high. You have this narrow leadership in markets. You have this consumer-driven economy, which is, as far as I can tell, almost entirely underpinned by US fiscal policy. And what we're trying to do now is understand US fiscal policy, and we are hoping that DOGE, deregulation, perhaps now debt restructuring, basically pulls off this fiscal experiment. I would just make a point here to say the Fed thinks US potential growth is 1.9%. US has been growing at 3% almost annualized for 2.5 years. If I strip away the government expenditure component, US growth is basically where the Fed thinks. Economies don't go from 3% to 2% nicely. That's not the way the world is. They're cyclical. And so if the US starts to lose momentum and people anticipate that it gets worse, that's how that cyclical dynamic unfolds. And if I look at the Atlanta Fed's GDP now estimate for Q1, it's halved from 4% to almost 2% in the last 2 weeks. That's not a good sign.
No, it's not. And we also have to talk about inflation. We stay with Callum Pickering, Chief Economist at Peel Hunt. Now, coming up, we also are 2 days out from what could be one of Germany's most consequential votes in decades. So we're live in Berlin with the very latest. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Weeks after the Bundestag was dissolved, Germans finally vote this weekend following an election campaign which has failed to turn around the fortunes of the Chancellor Olaf Scholz. Well, Bloomberg's Oliver Crook is outside the Chancellery in Berlin for us. Ollie, so set us up for what to expect as Europe's biggest economy heads to the polls on Sunday.
Yeah, that's right, Francie. I mean, for a snap election, it hasn't felt very snappy, right? We've been talking about this election for months and months and months, and really it's been since November the 5th, the same day that Donald Trump was elected president of the United States, is the day that Olaf Scholz, the Chancellor of Germany, pulled the plug on his three-way fractious coalition and basically paved the way for this election, which will get underway now on Sunday. One of the remarkable features of this election campaign, despite its length and despite for how long it's been going, is that really the polls have not changed a whole lot. From the very beginning, the CDU, Merkel's traditional party, now led by Friedrich Merz, has been at the #1 spot with 30% of the vote. And the other sort of interesting feature of this election campaign, Francine, as we've been reporting on for the last few months, is the prominent role that the AfD, the Alternative for Deutschland, the far-right party of Germany, is playing, coming in at 20%, the second biggest party in Germany for the first time since the end of the Second World War, and basically the first time that they've ever put on a chancellor candidate. When you look at the sort of historical outcome since the turn of the century in Germany with the leading party and what they have done in terms of the polls to lead a government, we're now expecting Friedrich Merz to get 30%. Olaf Scholz only had 25%, which is part of why he had to get into this very sort of uncomfortable coalition. What they are hoping for from the CDU is to break through with a much larger majority to begin actually really the hard work of this election, which will be the coalition forming after that Sunday vote.
But Ollie, I mean, this is a problem, right? The main danger is that the vote yields another fragmented parliament, which could leave a power vacuum really at the heart of Europe at one of the most complicated times. How difficult will it be to form a coalition, maybe even a grand coalition?
Yeah, Francine. So listen, this is exactly what you and I are going to be looking at on Sunday night, really most importantly in these sort of polls when we get those exit polls out at 6 p.m. By 7 p.m. on Sunday, we should have a pretty good idea of the composition of this next Bundestag. But Francine, as you know, one of the things that will be most important is not necessarily the parties that get the most votes, but the parties that get the fewest votes. Because if any party gets beneath 5% of the vote, they basically get booted out of the Bundestag, which basically redoes all of the arithmetic in terms of the parliamentary parties and coalitions that are possible. I think the base case right now in terms of probabilities is that grand coalition, a CDU, SPD coalition. That is something that we've seen very, very frequently in German history. It is something that we've seen with Merkel and Scholz. Scholz was finance minister, of course. But what we are expecting is that if the SPD does as poorly as they're anticipated, this is going to be their worst outcome since the end of the Second World War, really in the history of the party. That will mean that Olaf Scholz will probably go, which will make it easier to make that coalition. But the real question is, Francine, as you say, if those votes get dispersed across the political spectrum, you don't really have a strong showing. You could have yet another three-way coalition, or maybe even something more complicated than that. And that is really what I think the markets and what the German population, I mean, regardless of what you think, what Germany needs now is a sort of decisive leadership in this moment, particularly as it stares down the possibility of tariffs from the United States, which will basically guarantee a third consecutive year of contraction for the German economy.
Ollie, thanks so much. Oliver Crook there with the very latest, of course, from Germany. And we'll have full coverage with a special Sunday show as well. Let's bring back Callum Pickering, chief economist at Peel Hunt. Callum, I mean, the concern is that actually it's going to be fractured. It's going to be messy. It'll take weeks, if not months, to form a government. And that means reforms get pushed back.
That's right. I mean, look, I of course, I sound a lot like a Brit here with our oppositional politics, but, you know, in America and on the continent, we're all demanding consensus. No, politics is fragmentation by definition. So this is kind of normal in that sense. But the challenge is, of course, is what happens with the budget. How does Germany, which remains the most important economy in Europe, it's the anchor for the EU, how does it then deliberate the geopolitics and deal with this US issue? My hunch is we'll probably get there in the haphazard way with these coalitions. They'll come up with the deals on the stuff that really, really matters. That is military spending, it's what do we do with EU budgets, all the relevant stuff. But what Germany actually needs is supply-side reform to make it more competitive, probably policies that encourage consumers to do a bit more heavy lifting, to just rebalance the economy. It's much too oriented towards global trade at a time when global trade is weak, and those require reforms. I suspect actually the question we'll be answering or trying to ask ourselves 3-6 months down the line if this doesn't work out is how much further can the ECB go, because we're hoping here we get a demand side effect from the German election. If it doesn't come, then it's for the ECB to go a little bit further.
But Cam, there's also so much talk about the need for joint debt issuance to deal with defense, so it just puts Europe in a very sticky spot if Germany is not strong.
That's it. That's exactly where you need the consensus and where you need that anchor. But in the end, Europe now doesn't have a choice. Right? It's going to have to increase its military spending as a percent of GDP, and the challenge there for markets is, let's suppose, under whatever circumstances, there's an end to the conflict in Russia-Ukraine. Typically, what you would expect to see is bond yields come down, we take some inflation risk off the table, but actually what you would say is, okay, maybe the near-term inflation risks are down, but if you have more debt issuance across Europe to pay for military spending, it's going to be very difficult to cut welfare spending in these circumstances. That is probably going to push bond yields up. And so net-net, what you're looking at is a change in market leadership rather than, okay, we can be optimistic about the world.
Talking about optimism, I mean, the UK was also, I mean, we had an inflation print, which wasn't great, actually, which complicates matters for the BOE this week.
Oh, so the inflation print needs to be understood, I think, in the context of what we've seen across economic data for the past 4 weeks, which is consistent surprises to the upside. Now, that might be just expectations that just come so low, it stands to reason. You're too pessimistic, eventually you get an upside surprise. But I think from the Bank of England's perspective, what you would ask is, as we think about the rising employer tax in April, do firms have pricing power or not? In other words, can they push that tax onto final prices and therefore we don't have an unemployment problem? Or without the pricing power, do they lay some workers off? In the end, I think you prefer pricing power, low unemployment, because it means demand is strong as opposed to unemployment. And so my call for the Bank of England is we get 2 cuts. They won't go much further than that, and the economy will actually be a bit stronger than expected over this year.
Okay, interesting. Callum, as always, thank you so much for joining us.
My pleasure, thank
you. Chief Economist at Peel Hunt. Now, coming up, day 2 of the G20 foreign ministers meeting in South Africa after the U.S. snubbed the event. We'll have plenty more from the region next. This is Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology. the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bloomberg Invest is back. Join me, Sonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
So it's day 2 at the G20 foreign ministers meeting in South Africa after the U.S. snubbed the event. This comes after South Africa's President Cyril Ramaphosa said it will iron out wrinkles in its relationship with the U.S. Let's go straight to Bloomberg's Jennifer Zabazaja, who's in Soweto. So, Jen, what can we expect from the second day of the G20?
Yeah, Fran, I mean, a lot of what we saw on the first day was really sort of a doubling down of this relationship between the G20 members. We heard President Ramaphosa trying to at least not let a lot of the noise that we've been hearing between South Africa and the U.S. overshadow his agenda, which is really focused on not only amplifying the global South and African voices, but also promoting multilateralism and also really encouraging reforms of global institutions. That is something that he has pressed on about since he took over this G20 presidency. And so the expectation is that throughout today, we will continue to see more of these bilaterals happening. We did see Russia's foreign minister meeting with his Chinese counterpart, as well as South Africa and Brazil, Turkey and Russia as well. So a number of these members are meeting together to, as they say, address a lot of the geopolitical issues and see where they can find consensus. But there is no naivety here, right? There is the elephant in the room is that the U.S. Secretary of State Marco Rubio is not here next week. We will not see Scott Bessent at the finance ministers meeting. And so these members are trying to at least continue to strengthen the relationships that they do have and perhaps restart new ones like South Africa and the EU. But we spoke with the EU and they said, although they do see this moving forward, they do notice that there is this recognizable gap without the U.S., not just financially, but also geopolitically.
Jen, as always, terrific briefing. Jennifer Zabazaja there at the G20. Coming up, we'll get the take of a former German ambassador on what Sunday's election will mean for Europe. That's next, and this is Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Chinese e-commerce giant Alibaba soars after reporting better-than-expected gains in e-commerce and cloud services, buoyed by AI-related demand. The French president and UK prime minister are both set to visit Washington next week after the US sidelined Europe and Kyiv in talks with Russia to end the war in Ukraine. Plus, will undecided voters in Germany dent the lead of conservative Friedrich Merz? We'll have full coverage and analysis of this weekend's election. So, on Sunday, Germany will go to the polls to elect a new chancellor. With Ukraine and European security high on the agenda, the results will, of course, have wide-reaching impacts across the continent. We can now speak to the president of the Munich Security Conference Foundation Council, Wolfgang Ischinger, who's also a former German ambassador to both the UK and the US. Ambassador Ischinger, thank you so much for joining us. When you look at the new world order that seems to have been laid out at the Munich Security Conference, how important is this for voters when they go to the polls on Sunday in Germany?
Well, let me make 2 points. First, of course, you are absolutely right that what happened in Munich is what we call in German, an obvious sign of the Zeitenwende, of the massive change in international relationships, beginning change, apparently, of the relationship between the United States and Russia, etc. So important things are happening. That's obvious. Second point is, in the German election campaign, these questions, if you ask me, should have had a priority place, but they didn't. The German election campaign focused on 2 other issues, which are admittedly for the German citizen very important. One is migration, and the other one is the flagging German economy. But I regret, as a foreign policy person, as a former diplomat, as the president of the Munich Security Conference Foundation, I regret the fact that we have not spent more time in this election campaign thinking and debating about what Europe, what Germany in particular, should do, must do now in order to defend European interests and make sure that our interests, for example, with respect to Ukraine, are not going to be ignored by Russia, the United States, and possibly others.
Yeah, but Professor, what does Europe need to now do most urgently? There's a number of reports that a number of presidents or heads of state will travel to Washington. Does Europe need to go at it alone, or do they need to negotiate with Donald Trump?
Well, of course, we will need to negotiate with Donald Trump. We are members of one and the same alliance. Let's not forget that there is still NATO, and NATO is the framework in which we've been working together for practically 3 generations. But but it's also true that Europe, as such, has not been able to come up with a clear plan supported by, appropriate capabilities. That's the European problem, and this is why I support those. I advocate for a more credible European Union in the area of foreign policy, security, and defense. We need to get our act together. We need to speak with one voice in these matters, and we need to spend more. That's also quite obvious. So in other words, we have a very full plate in front of us, and the next German chancellor, who will be elected this weekend, will need to respond to these international concerns in addition to the domestic concerns which I just mentioned, migration and the economy.
Ambassador, will Friedrich Merz, who looks like Germany's next chancellor, be able to lead Europe and Germany out of the mess it's in?
Well, what I know Friedrich Merz quite well. In fact, I have to admit, for transparency reasons, that my wife has actually written a biography of Friedrich Merz. So at our kitchen table, we've been talking a lot about him. I know that he is a very, very committed European. He served in the European Parliament before he became a leader in the German setup. And I know that he is totally aware that if there is no adequate Franco-German, Polish, etc. leadership in the European Union, no leadership will be possible. I think he knows that, he accepts it, and I have very positive expectations that he will meet these expectations as soon as he is actually elected, which unfortunately, under our German system with coalition treaties needing to be worked out, which actually may take several weeks, may last until way into the month of March, maybe until the end of March.
But Ambassador, is this your biggest concern, that if it takes a very long time to build a coalition, it'll be very difficult and very painful to push also through some of the reforms that the German economy so badly needs? Forget even what Europe needs on defense.
I'll be the first to admit that these German elections are not coming at the best moment. Absolutely, it would have been much better if we had an election before Donald Trump started his rather fundamental policy changes on a number of issues, the EU-US relationship in terms of tariffs and trade, the Ukraine issue, and a number of others. But this is the way it is now, and it is a bit unfortunate that we are not going to be doing, from the German side, what Emmanuel Macron is now trying to do by going to Washington next Monday, talking to President Trump. It would be great if an elected German chancellor could join him and could, chime in and present a united European leadership view. That will have to wait a couple of more weeks, I'm afraid.
Ambassador, do you still see a chance that Europe or others will be able to convince President Trump off the pro-Russian course that he seems to have chosen, or is it too late?
Well, let's see what will emerge. We don't have negotiations yet. What we're having are statements by this side, by that side, about the future of this, how this will be handled. Once negotiations will really seriously start, I think people will realize that this is going to be a difficult, lengthy, complex issue where we will be facing, we, the West, the United States, and Europe, hopefully together, a very, very demanding Russia, a Russia represented by extremely experienced negotiating folks. I have known Sergei Lavrov, the Russian foreign minister, since 1994, in other words, for 30 years. He is one of the most experienced diplomats that I have had the privilege meeting in my career. In other words, these are not going to be easy discussions and negotiations. We're dealing with very experienced, very crafty folks on the Russian side. So don't expect quick results anytime soon. And I think the United States government, the Trump administration, will find out that this Russian regime is a very tough nut to crack. That's my view.
Okay, thank you so much, of course, for all of your analysis. The president of the MSC Foundation Council, Wolfgang Ischinger, there. Now, also join us on Sunday. We have a special show from Berlin as polls close in Germany. That's at 5 p.m. London time, 6 p.m. in Berlin. We also had some UK PMI numbers. This was very interesting in the light of what Callum Pickering was saying. We had an inflation print that was higher than expected over this week. So he's now, for example, saying that the BOE can only do 2 cuts this year. UK February services PMI rising to 51.1, manufacturing falling to 46.4. Coming up, we'll have plenty more from the markets as Air Liquide reports annual results. We'll talk exclusively to the chief executive of the French chemicals company. That's next, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Air Liquide shares have jumped after the French chemicals company reported higher margin guidance after full-year results were described as in line. Well, the company's chief executive, François Jacov, joins us now. Mr. Jacov, thank you so much for joining us. There's a number of challenges out there. What's your outlook for Air Liquide in the next couple of quarters?
Good morning, Francine. Thank you very much for the invitation. As you have just said, I mean, indeed, we have published a record year for Air Liquide in 2024. That was clearly a record in terms of margins and margin improvement. That was also a record in terms of commercial successes with investment decision at a record level of 4.4 billion euro. And also, we have been doing this by reducing our CO2 footprint in absolute value. So as you can see, clearly, that was a record year where we showed and demonstrated resilience, performance, and preparing the future. So all this is good. and we are looking forward to 2025 in a quite challenging context for sure, but relying on the strengths of Air Liquide.
Mr. Jakov, the European chemicals, of course, autos and steelmaking industries are really suffering for a number of reasons. Add to that extra tariffs and a possible trade war with the U.S. How is Air Liquide preparing for that?
You know, Air Liquide, due to the nature of our business, where we make industrial gases for the manufacturing industry, but also, I mean, for the healthcare sector, we are a very local business. So we basically build a plant and infrastructure in the country where we operate. Our products do not travel across boundaries, across frontiers. So in this world where there's a lot of discussion, talk about tariff, Air Liquide is quite resilient and protected against that. Because when we operate in the US, we are an American company producing locally. When we do the same in Canada, we do the same in Germany. This being said, we have to be, of course, very cautious because there could be indirect impact for our customers who may be affected by the increased tariff globally. And that's true for many companies across the world.
Jakov, in France, the government is also raising taxes on companies to reduce the deficit. How much concretely will that impact Air Liquide?
Again, the model of Air Liquide is very resilient, including regarding the tax, because as we are a local company operating and paying taxes in the different countries where we operate, the impact of the increased tax in France will be limited, probably between 1% and 2% of the net earnings of the group.
Mr. Jakov, has Europe been too ambitious in terms of green ambitions in general, given what's happening at a global level?
Well, I think we have to recognize, I mean, the leadership of Europe to tackle very important issues related to global warming and basically the impact of the economy of industry. So I think this is really something where Europe has been showing the way. Now, how Europe has put that in practice, I think that's probably the issue. We have seen a lot of complexity in the way Europe has set the rules, even the support for companies to decarbonize the industry or to decarbonize the transportation. And that's really what is hurting the European company. But I think the intent is very valid. Hopefully, I mean, the decarbonization objective is there to stay. And we have to recognize that in Europe, the energy transition is an opportunity to renew the industrial footprint and also to ensure sovereignty through a strong industry in Europe.
Okay, thank you so much. François Jakov there, the Chief Executive of Air Liquide, for joining us this morning. Coming up, Citibank has announced that it is scrapping its diversity goals. This comes in the wake of political and legal pressures under the Trump administration. More on that next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
This Sunday, Germany heads to the polls following the collapse of Chancellor Scholz's coalition. With the focus on the economy, migration, and geopolitical tensions, how will the German balance of power shift? Bloomberg Television has continuing coverage leading up to the election and will bring you the results after the votes are tallied with a special post-election broadcast. Tune in Sunday, starting at 5 p.m. London time. Only on Bloomberg. Context changes everything. Alibaba's ADRs jumping in U.S. pre-market trading after the company posted stronger than expected revenue gains in its e-commerce and cloud services division. Now, for more on all of this, our top corporate story of the day, let's bring Bloomberg's Peter Elstrom, who leads our global technology coverage. So, Peter, what has got the market really excited about Alibaba?
Well, it was a pretty extraordinary earnings report. The company, as you said, reported pretty strong earnings. It's a business that has largely been built on the e-commerce operations there, much like in Amazon, but also their cloud computing business was very, very strong. It grew 13%. That helped them grow overall the top line faster than it has in more than a year. But what really got investors excited here and really drove the stock price yesterday is that the executives talked a lot about their AI ambitions. They're tacking hard into artificial intelligence. They've been investing quite a bit of money. The CEO, Eddie Wu, went so far on the conference call to say that artificial general intelligence, or AGI, is now the primary objective of the company, and they're going to invest more in the next 3 years than they have in the past 10 years. And that sent the shares skyrocketing. They went up more than 10% during trading yesterday, added about $25 billion to their market cap. So it sounded a little bit like a conference call with DeepSeek or OpenAI, where they're talking a lot about their AI ambitions and less about the e-commerce business. It's really been the foundation of the business so far.
Peter, what does this mean for the AI sector in general?
Well, it's very much a new competitor, a very aggressive competitor. It's important to remember that the China market is separate from what we're going to see globally. U.S. players are not going to be able to go into that market the way that they would in, say, Europe or someplace like that. So the real competitors are going to be domestic. DeepSeek, of course, got a lot of attention a couple of weeks ago when they came out with this low-cost advanced AI model. But the other real competitors are Baidu, the search company, has done quite well. Tencent, which is the games giant that also has accelerated quite a bit. And now Alibaba has really jumped ahead with a couple of key accomplishments. They came out with an AI model called Gwen, which on most of the benchmarks competes quite well globally. In addition to that, they look like they're going to be the AI partner for Apple on the iPhones in the China market, which is a very big accomplishment for them. They're moving ahead Again, the Chinese government is not going to let some other foreign AI model work on the smartphones within the country. So Alibaba getting to be that partner with Apple is going to be a big accomplishment. But Eddie Wu was very clear. He said, we don't know what AI is going to be used for in the future. The key thing is that we invest now so that we're in the game in the future and we're able to offer those opportunities, whatever they happen to be. He also talked about how AI is now becoming such an important part of the economy that perhaps it could replace or participate in 50% of global GDP at some point in the future. So they have very, very high ambitions and big dreams about how they're going to play a role here.
Peter, thanks so much. As always, Peter Elstrom, of course, in charge of global technology, joining us from Taipei today. Now, let's wrap up some of the news from the banking sector this week. And Standard Chartered has announced that it's boosting its annual bonus pool up 7% from 2023. Citi also announced that it is rolling back on its diversity initiatives. Now, for more on this, Bloomberg's Jennifer Serrain, who leads our UK and Middle East finance coverage, joins us. So, Jenny, I mean, there's a lot going on, frankly, in global business, but certainly there is in banking. Standard Chartered annual bonus pool up 7%. Give us the details.
Yeah, so I think it pretty much mirrors what we saw across Wall Street this quarter. A lot of these banks were able to kind of navigate this volatility. Their trading desks did really well. The fact that interest rates have come down ever so slightly and deal makers feel like they have a little bit more certainty on the regulatory environment with Trump coming in means that M&A is really looking good. So a lot of these banks set aside more to make sure that these traders and deal makers stick around this year to help them kind of further take advantage of all these gains.
Other key takeaways, it seems like CEOs got a lot of pay rises.
Yeah, no, definitely in the UK, I think it was something interesting this quarter. It was we finally started to see the removal of the bonus cap kind of coming through. And so that was a really big push that the UK made to kind of get itself on better footing in terms of the global financial landscape, breaking with the EU in that way. And so, yes, the Standard Chartered CEOs pay out today and sort of similar with what we saw from Barclays, HSBC, and all the rest. Yeah, really giving the CEOs something to work for and boosting their potential bonuses.
Jenny, talk to us about Citi. So this is just the latest bank actually ditching their diversity. Is it diversity goals or just the initiatives?
No, it's the goals. And this is on the heels of the pressure from the Trump administration, who's issued a series of executive orders on this. But there's also been some lawsuits in the U.S. that kind of make it really difficult for companies and especially federal contractors to have very specific diversity targets. So Citi for many years now has been trying to increase the representation of women at the assistant vice president to managing director level. That's kind of key. If you want to see more women in the CEO role like you have at Citi, you have to kind of start in that middle level and making sure that you're really keeping up there. But yes, with all of the political and kind of regulatory changes in the U.S., you've seen not just Citi, but lots of banks have to abandon these efforts. So I think that we're really only at the start of this, and we're probably going to see a lot more activity like this going forward.
So Jenny, I mean, we had Goldman Sachs actually say that also they've reached some of their goals. Are most Wall Street banks now openly said that they were abandoning them?
We haven't heard officially from all of them. I think this is something that executive management teams across Wall Street are actually looking at right now. The way that these different legal cases and executive orders were written means that, and the way that the different goals that the banks themselves had, it just means that I think it's going to be a long process of figuring out, okay, I think we're able to keep this has to go. I mean, they're also dealing with what their employees have to say about this. And the reason that a lot of these banks originally set this out was they were facing pressure from employees to set these goals. So it's a lot of tight ropes that they have to walk. And I think that's why we're expecting to just hear a lot more from Wall Street on this.
Jenny, thanks so much. As always, Jenny Serrain there, who leads our UK and Middle East finance coverage. Now, another reminder to join us from Sunday, live from Berlin, for a special program on the German elections. That's when polls close at 5 p.m. London time, 6 p.m. in Berlin. This is Bloomberg.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Bloomberg Invest is back. Join me, Sonali Basak, and the industry's most influential people for a comprehensive view across financial markets. Hear what a second Donald Trump presidency means for the economy, how AI is being monetized by investors, and the next big risks facing the private credit industry. Bloomberg Invest, March 4th and 5th in New York City. Register your interest to attend at bloomberglive.com/invest.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning and a happy Friday from our global headquarters in New York. I'm Danny Berger, Manus Cranny on assignment this morning. Welcome to Bloomberg Brief. Let's set your agenda. Rate uncertainties. Fed's Muslim backs modestly restrictive policy. Bostic says his economic outlook may change in just 6 months' time. Ready to step in, China vows to boost its service sector. Governor Ueda warns the BOJ can intervene to quell the latest surge in yields. And Washington and Kyiv talk over a mineral deal in stalemate as tensions remain high. Well, we've fallen back from the all-time highs. We managed to reach 2 in the past week. We're a little change this morning on your S&P 500 futures. NASDAQ 100 futures lead the charge higher. That compares to what's happening in China tech. Take a look at the bottom of your screen. 6.5% move higher thanks to Alibaba. Those earnings were good. One more earnings poor. That really seemed to be what set risk off yesterday. When it comes to bonds, U.S. Treasuries, yields declined rather yesterday. The decline continues today, down about a basis point. We're under 4.5% for your 10-year yield. Scott Besson telling the Bloomberg surveillance team that moves to term out the debt were a long way away. The bond market like what it heard. Gold is weaker this morning, but it is trading just around a record high, just under $3,000. Investment banking houses around the world upping their calls for the price levels of gold this morning. So that's a look at the overall picture for markets. Let's take a look at some of the individual stocks on the move. As I mentioned, Alibaba rising. If we take a look at its ADRs in the U.S., up 3.7%. It reported the fastest pace of revenue growth in over a year, driven by strong gains in e-commerce and cloud services. Also keeping an eye on Standard Chartered this morning. It hit its highest level in more than a decade. Shares up 4% in the London trade. The firm's buyback and dividend both came in higher than expected. Rounding things out with Rivian in the pre-market, shares are falling 2.2%. The EV maker issued a downbeat first quarter vehicle delivery forecast. That miss did overshadow its first ever quarterly profit. And just a few moments, we're going to catch up with Laura Cooper of Nuveen. Later this hour, We'll talk stocks, we'll talk derivatives and options with Amy Wu Silverman of RBC Capital Markets. So as I mentioned, longer-end treasuries, they are continuing to modestly gain after Secretary Scott Bessent spoke to Bloomberg on whether boosting the issuance of longer-term notes is in the future.
That's a long way off. And we're going to see what the market wants. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
I'm pleased to say that joining us now is Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Laura, great to see you as always. Since the start of this year, long-end bonds, that is 10-year yields, are lower by about 9 basis points this year. The call had been for more tension, maybe more inflation because of tariffs. That hasn't played out. But I wonder what to you is the bigger driver for bonds at this point. Is it what we hear from Scott Bessent? Is it the technical structure of issuance of bonds? Or do you think we're starting to see some growth concerns creep into the long end?
I think what we're starting to see is some of those growth concerns come into the long end. I mean, if we think about what the market moves have been really since the September 50 basis point cut from the Fed, about 70 basis points of that move alone were driven by the term premium. So that largely captured a lot of the fiscal uncertainty. And then we've also seen a significant move in break-evens, and that's capturing the inflation expectations climbing higher. So that could arguably be already baked into the price. And so now we're shifting to other factors of the backdrop, and it's one of the reasons why we continue to be quite cautious on duration and see range-bound trading for that U.S. 10-year from here.
Can that cautiousness prevail, Laura, at the same time that equity markets hit new highs? Because if it's growth concerns that's moving bonds, shouldn't the same be said of equities?
That's a great question. I mean, I think when we think about what our outlook is for the bond market, it's not necessarily that we're going to see a significant catalyst that would spark a rally in the Treasury yields. Instead, it's really just this lack of conviction on a direction either way, in sense of what will the inflation impulse be from these new U.S. policies coming through, and what could the knock-on implications of growth and even the potential issuance that we could see change later this year. There's not a clear direction for Treasuries. Whereas for equities, we're clearly seeing the earnings picture. Yes, it has been quite mixed, but again, the liquidity backdrop is so ample that we're not necessarily seeing that similar type of growth catalyst to prompt a sharp drawdown.
What would be the catalyst to break bonds out of a range, to kind of shake us from this, I guess not complacency, but as you kind of framed it, this unknowingness? We have a lot of tariff deadlines soon approaching at the end of this month, or the start of March and the start of April. Is that the catalyst that this bond market needs? Because for now, it's really shrugged at any sort of tariff news.
Well, and I think what's been interesting is if we think about the general thrust of the Fed speak that we've had over the past couple of days, it really does just capture this heightened degree of uncertainty, predominantly around the inflationary effect of some of these policies coming through. So we would probably need to see consecutive months of upside inflation surprises, building on that upside surprise that we saw more recently, for the Fed to become even more cautious. They are data dependent, and if there's a signal that they're going to have to keep rates in even more of a restrictive territory for further. I mean, we're still penciling in a cut in September, potentially another one in December. If those start to get pared back on those inflation expectations, then perhaps that's when we could see more of that negative downside to break treasuries from their current trading range.
To that point, Bostic saying yesterday, there's a decent chance that my outlook today is not going to be the same as it is 6 months from now. That underscoring just how much uncertainty there is. But Laura, we're coming out of this period where there's been extreme sensitivity to inflation on the part of central bankers, understandingly so, considering they kind of missed and said the whole transitory thing. It wasn't so transitory. But if we are going for an environment where both growth is under pressure and there are inflation concerns because of tariffs, what do you expect the reaction function of the central bank to be?
And I think what we're seeing is this divergence in the outlook on the inflation and growth backdrop from the U.S. in terms of what we're seeing in Europe and the U.K. We still have a fairly favorable growth backdrop for this year, let's say real GDP around that 2% mark, whereas in Europe, the growth risks are clearly tilted to the downside. There's less conviction, I would say, from policymakers that we're going to get back to that 2% inflation target, certainly in any time soon. And then even in the U.K., we are continuing starting to see the stagflationary environment coming to the forefront. And so from a central bank perspective, will they actually have to keep rates on pause a little bit longer? That's not necessarily our base case. We still think both the Bank of England and ECB will have to cut rates quite aggressively in the second half of the year. And it's one of the reasons why we've been positioned in duration in those exposures rather than taking on U.S. rates.
And then it gets back to this irony, but this time in the Europe markets when it comes to equities, of equities in Europe hitting an all-time high on Tuesday. Laura, is that a trend you'd want to follow or push back against?
We had been getting more comfortable with European equities from a valuation standpoint, but if we look at the price action year to date, we have the benign tariff backdrop feeding in. We have the potential for a peace accord between Russia and Ukraine. There is also this fiscal impulse being priced in from a potential new German government. All of those three pillars, I think, are still on shaky ground. We don't have strong conviction that European equities can continue to advance, certainly at the pace that they have been. So we're a bit more cautious, and that largely reflects a lack of clarity on what the tariffs could actually be for Europe. We think that's going to have a more negative growth impulse coming through, and so it's important to be more selective in those European equity exposures rather than taking on broad benchmarks from a valuation standpoint.
Laura, is there any signal to be gleaned from German elections this weekend? How important is the outlook for that when it comes to things like this European bond market and equity market?
I think it's crucial when we think about the potential for debt reform coming through. I mean, markets are certainly pricing in the expectation that we could see more fiscal stimulus coming through. If we do see those fiscal levers being able to actually be used in the future, I think markets are getting a bit ahead of themselves, actually, because even if we see a two-party or three-party ruling coalition that will lead to that revision of that debt brake, we're not going to see any meaningful fiscal impulse, probably until later this year, but it's mostly going to be a 2026 story. And even then, we see an incremental change, at most 1% of GDP. So not really enough to materially change the outlook. And it's one of the reasons why we still think German bonds are quite attractive at these levels.
Yeah, and fair enough. Even Macron talking about the need for more defense spending, Laura, he's talking in a 5 to 10 year time frame. It's really just emphasizing what you say, that it's not going to be an immediate boost. Laura, I'm afraid that's all we have time for. Thanks so much for joining us. Laura Cooper of Nuveen. And just a programming note, we are going to be catching up with Oliver Crook in Germany in the next half hour to speak about the German elections. Now to other top stories that are trending on the terminal this morning. UK retail sales grew 1.7% in January. That is an exceeding of expectations. The rise was driven by consumers that spent more on food to eat at home. Food sales were the strongest since the start of the pandemic in March 2020. But consumers do remain cautious with decreases in other categories and weak consumer confidence. Meanwhile, in China, officials are mapping out plans for tapping the nation's huge customer base. This comes as Treasury Secretary Scott Bessent prepares to refresh calls for Beijing to decrease its dependence on exports. The Chinese premier urged to improve the supply of services in several industries, but didn't elaborate. Officials are expecting to set an ambitious growth goal of around 5% for this year. BOJ Governor Ueda warns that he was prepared to intervene in the bond market to stifle a surge in yields. He reiterated the central bank's commitment to supporting stability, though he did give little hint on whether any bond action might take place in the near term. Ueda's comments led to a fall in yields and a weakening of the yen. Now, as I mentioned, coming up on the show, Germany heads to the polls. We are live in Berlin with the latest on your Bloomberg Brief.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
He needs to come back to the table, and we're going to continue to have discussions about where that deal is going. Again, we have an obligation to the taxpayer. I think this is an opportunity. The president thinks this is an opportunity for Ukraine going forward. There can be, in my view, nothing better for Ukraine's future and for their security than to have the United States invested in their prosperity long term.
That was U.S. National Security Advisor Mike Waltz calling on Ukraine's President Zelensky to come back to the table and work with the U.S. on a deal with Russia. The deal includes what happens with the country's minerals. Axios reporting that the Trump administration has offered Kyiv an improved draft for minerals agreement between the nations. Joining us for more is Bloomberg opinion writer Mark Champion. Mark, this was a deal that Zelensky seemingly rejected. There had been reporting that he was kind of thrust upon it during the Munich Security Conference, and it didn't have enough security guarantees for Ukraine. What do we understand about what this deal is actually about and what is being offered to President Zelensky?
Right. Well, so very briefly, the first thing is that this is an idea that was first put forward by Zelensky, who was thinking of basically how can I interest Donald Trump in engaging in trying to get a decent deal for Ukraine and providing security guarantees. So it was his idea. But the deal that was presented to him, from what we know of it, was it was more like, the kind of thing that you would impose on a country that is defeated as war reparations. President Trump made it very clear that he saw this as recompense for money that the U.S. has spent. And then what the deal really did was to say, we're going to set up a fund. The U.S. will own 50%. And 50% of all revenues in perpetuity from all of Ukraine's, mineral resources, infrastructure, ports, etc., would go to the U.S. Within that deal was the part was missing that Ukraine had, proposed it for, which was the security guarantees, any idea of what the U.S. would do for them. So Zelensky rejected it. Now we have apparently, an improved deal. He seems to be more open to that. We don't really know the precise details of the new deal, other than the jurisdiction for the deal, it seems, is no longer extraterritorial, no longer in New York.
Mark, it gets to this other matter in terms of what the motives are behind what the Trump administration is doing. Is it to bring an end to the war in Ukraine, or is it to improve the U.S.'s position? And this brings us to what's happening in Russia. Treasury Secretary Scott Bessent yesterday on Bloomberg saying that there could be more imposition of sanctions or use of sanctions as a tool in this war in Ukraine. But we also heard from Marco Rubio after his meeting with Russian counterparts, continually bringing up this idea of economic opportunity in Russia. So how is the U.S. viewing sanctions? As a tool to remove them, to improve the U.S. economic relationship with Russia, or as a cudgel to end the war in Ukraine?
Right. Well, I mean, it seems clear that the administration sees sanctions, lifting them or imposing some more, as leverage with Moscow. It's something, big they can offer, lifting sanctions. The threat from increasing sanctions is, it's less clear how big that is, given that mainly the U.S. has been talking about sanctioning trade between Russia and the U.S., which is, almost is minuscule. But nevertheless, they clearly see that as leverage. The question really is, what is the priority here? And if you look at what the U.S. has been doing, it seems fairly clear that the priority is that they want to get a reset with Russia. They want that to bring, economic benefit to the U.S., and they are less concerned about, getting the best possible deal for Ukraine, or for that matter, for involving Europe. So that this is where the concern has arisen. There's no problem with putting sanctions on the table. That's obviously, they were imposed over the war. It's obviously leverage if you want to end the war. But the discussion has been really, to put sanctions. Rubio was talking about, sanctions and the possibility of lifting sanctions to get this wider deal. And ending the war is a sort of, another tool in those negotiations, a sine qua non, really, but maybe not the first priority.
Mark, we always really appreciate your time and your thoughts. That is Mark Champion from Bloomberg Opinion. Now, staying in Europe, Germans head to the polls this Sunday. German Chancellor Olaf Scholz has struggled in that. Elon Musk has also waded into the debate to support the AfD. And Vice President J.D. Vance's words in Munich last week still looming large over the continent. Bloomberg's Oliver Crook is outside the Chancellery in Berlin for us tracking the election. So we have 2 days to go until the polls. Oliver, what's at stake? What does it look like?
Yeah, Danny, I mean, this is a journey that really began on November the 5th when Olaf Scholz pulled the plug on his government, the fractious sort of coalition that he had been holding on to for a little while, and then eventually pulled the plug because they just couldn't agree. They couldn't find a budget. They couldn't basically decide how to spend the money in the next year. And that, of course, Danny, was the same day that Donald Trump was elected president of the United States. And that has turned out to be a fairly fateful date for the German economy and indeed for the continent of Europe. Looking into this weekend, what has been sort of remarkable throughout what this has been a very long election campaign for a snap election, Danny, is that basically the polls have not moved, right? The CDU, Friedrich Merz's party, Angela Merkel's traditional party, has been leading with 30%. But the other sort of main feature of this election campaign that makes it different from ones of the past is the existence of the AfD as having a chancellor candidate for the very first time. They're getting about 20% of the vote. And as you mentioned, Danny, another sort of new feature of this election is the degree to which another country and the United States has been wading into domestic politics in Germany. This is something that is really without precedent and something that really sort of caught everyone's attention the last weekend at the Munich Security Conference when J.D. Vance was being intensely critical of basically mainstream political parties here in Germany and taking a meeting with the AfD head Alice Weidel instead of Olaf Scholz. So heading into the polls here, what we're expecting is the CDU to win. But again, Danny, anecdotally and also according to the data, a lot of the people you speak to in Germany to this day, 2 days away, do not know who they're going to vote for. That could throw up something very interesting on Sunday.
Oliver, to that point, it's in a period of fractious times for Europe, given what the U.S. has done, given the threat of tariffs and putting defense solely on the shoulders of Europe. We have a weakened Macron in France. Is there a situation where you get real leadership coming out of Germany, or is what you're describing in the polls, again, a continued vacuum in the largest economy in Europe?
Yeah, so listen, Danny, there's something really interesting here because I think that Friedrich Merz potentially has all of the ingredients to not just become Chancellor of Germany, but become basically leader of Europe. That is, of course, not a formal role, but as you mentioned, there's a massive leadership vacuum within Europe at a time in which you really do need strong leadership. You need to face up against the economic threat of China. You need to face up against the economic, political, and whatever the threat it is that's coming from the United States. And Friedrich Merz potentially could be that person, particularly if he is willing to move. And this is a very difficult discussion on the question of joint debt at the European level to finance some of that defense spending. And again, you come to Brussels with that chip as German Chancellor, you have a huge amount of power, and that is the sort of path that potentially he could be paving. But again, Danny, if you see a really fractured situation here in Germany, you're going to get paralysis not only in Europe's biggest economy, but in Europe as a whole.
Oliver, we really appreciate it. Our thanks to Oliver Crook outside the German Chancellery. And don't miss Oliver and the team's special coverage of the German election this Sunday. That will start at 12 p.m. Eastern, 6 p.m. in Berlin. Coming up, Tesla may be coming to Nissan's rescue. We're going to have more on that story for you next.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference. Putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Let's take a look at the front pages this morning. First up on the Financial Times, reporting that a high-level Japanese group has drawn up plans to seek investment from Tesla to help aid Nissan. Sources say that the group believes the EV maker is interested in acquiring Nissan's plants in the U.S. Nissan shares jumped more than 12% on the news of that potential investment. Next up, the Washington Post has this, reporting that President Trump is expected to take control of the U.S. Postal Service. He's expected to issue an executive order as soon as this week to fire members of its governing board. And Axios reporting that the Trump administration has given Ukraine an improved draft for the minerals agreement. Sources say that Zelensky's aides have encouraged him to sign the updated proposal to avoid a further clash with Trump.
what legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Well, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of no. Myself, 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Rates uncertainty. The Fed's Musalem backs modestly restrictive policy. Bostic says his economic outlook may change in 6 months. Ready to step in, China vows to boost its services sector. Governor Ueda warns the BOJ can intervene to quell the latest surge in yields. And Washington and Kyiv talk over a minerals deal in stalemate as tensions remain high. It's the Friday of a holiday-shortened week, and we fell back from record all-time highs yesterday. We're attempting to claw something back today. We're a little changed, though, on S&P 500 futures. NASDAQ, Russell, those are up a bit more, but it is tech in Asia that's really the standout. The Hong Kong Tech Index closing at 6.5% higher with strong earnings from Alibaba. But yesterday, it was the weak earnings from Walmart, the concern on their forecast, weaker than expected, and consumer spending. Meanwhile, U.S. Treasury yields are declining this morning, down, let's call it 2 basis points if we're going to round up for your 10-year yield. We are below 4.49%. Scott Besson aiding this bond market yesterday, saying that it would be some time until they term out the debt. Gold, meanwhile, takes a notch lower from reaching all-time highs. $2,929 an ounce is where gold stands this morning. So stocks did retreat after 2 consecutive record highs for this year. RBC's Amy Wu Silverman weighs in on the recent strength in equities, writing, quote, "In the past few weeks, we have seen a meaningful shift in the vibe from investors. In fact, there appears to be a clear disconnect between what the market is actually doing, i.e. reaching highs, and how investors feel. Very cautious." Amy joins us now. Amy is head of derivatives strategy at RBC Capital Markets. Amy, so wonderful to have you. And I think this quote is perfect for the time we're in because there's so much uncertainty, yet all-time highs. Just that break in sentiment versus positioning, what does that mean? How prepared this market is when it comes to hedges? Should things turn more sour?
Well, good morning. Look, I don't want to say there isn't hedging. There certainly is some, especially if you look from year on year, last year to this year. Hedging levels have increased. There is more cautiousness in the market. But at the same time, when you think about headline VIX, where it is, Danny, folks still kind of seem kind of sanguine. And this conundrum, I've just been calling it the paddling duck market. I know I brought that up before, but it's just this idea that, this market continues to look calm and smooth on the surface. A lot of these violent rotations are furiously paddling underneath. You actually even see it in the Mag 7, Danny, where, half the names are doing well, the other half aren't, but you keep getting this cancellation on the index level.
Yeah, Amy, I believe last time you were on, you said the paddling duck could fall down a waterfall, which made us all very sad for the paddling duck.
Poor duck.
The poor duck. Do you think there's some degree where we're just too sanguine about this idea of a President Trump put? Do you think that's what's behind this market's ability to continue to be a paddling duck and look calm on the surface?
Yeah, look, this is completely anecdotally, but one thing I've heard as a refrain, that's just this chorus from investors since last year, is that Donald Trump is going to manage the stock market. He views it as a gauge of his success. He doesn't want it to go down, and he'll consider that when thinking about implementation. And we were just speaking with investors in Toronto last week, and I can really tell you that tone has shifted, and the questioning of whether or not that is true, I think, is coming to the forefront. So that's why you're seeing this bubbling of cautiousness. The other thing I would say is, we're kind of heading to levels both in terms of volatility and the market where it doesn't take that much. We just need kind of a pickup in correlation. We've had this very high dispersion environment to really trigger something that could be a lot worse, which is why I think folks are, I'll call it hedging curious in a way they haven't been before.
Hedging curious. I love that, Amy. I mean, where it makes sense, though, to hedge at this moment? There was a point in time where you could say maybe your Mag 7 could be something of a safety trade. As you mentioned, that's not playing out as is. The VIX looks pretty calm at this point. What hedges will actually pay off and won't just be throwing money into a fire at this point?
And that I would say is what I spend the bulk of my day job thinking about, meaning, you can say hedge all you want, but it's got to be an effective hedge, because you think back to years like 2022 where hedges really didn't work and you still got a market drawdown. And that's a really tough place to be if you're a CIO or a CRO. So, two suggestions here. One is that I actually think traditional hedges, which haven't worked that well in the past, so your S&P puts or your VIX calls, they actually could do better, Danny, if you just believe that we're going to kind of get away from this very high dispersion environment. So correlations could pick up. That obviously fuels your volatility factor. I think that could happen just because of a lot of the intercorrelated macro risks. The second is you have to be very idiosyncratic. So whatever your positions are as a portfolio manager, think about doing those single stock hedges versus necessarily looking at the index level.
Amy, one thing that you write about that I find really interesting is the comparison between the melt-up in the markets now versus the post-COVID environment. This idea that after COVID, as you write, that you had to participate in the market, the kind of FOMO melt-up, the Mag 7 dominating things. How different is that narrative this time around? Is there still this idea that you have to participate, that you're going to miss it if you don't?
An interesting thing is I think retail still has that memo when you think about where the flows are and you think about the pockets of the market they're investing in. The second aspect I would say of this is there is this issue, because investors have kind of learned this post-COVID, that if you're not in the weightiest names, then you're going to drag your benchmark, and you cannot afford to do that. So structurally, we haven't talked about this, but one thing I think is interesting is you have a lot of folks who are long, and so they're essentially selling volatility as a way to harvest incremental yield and essentially saying, maybe we're going to grind from here. That's another reason you're getting the suppression in the volatility complex. And again, a trigger and correlation could change that. It wouldn't take much. But, I do think people have learned to jump in the pool, to hold that right tail. That's been much more the story of these past 4 years. It's hard to shake that story, Danny.
Well, when it comes to catalysts that could shake the story, Amy, how important is 5 days from now, February 26th, when we get NVIDIA earnings?
I think I put in the notes that NVIDIA is the OG of this entire AI trade. I stand by that. Look, it's May 2023 at this point when it triggered this entire AI thematic run that we've had that continues to be so important to not only the AI names specifically, but the AI adjacent names. You just can't discount how important one single name can be, not only because of its weight, but because of the complex that it supports. So I think, when you look at earnings day volatility there, it probably is justified given how important that single name is.
So there's volatility on that day, Amy, but I wonder if any of the other tariff dates get to the level of event risk. You have auto and chip pharma tariffs due April 2nd, reciprocal tariff, that investigation's also due early April. Before that, the steel and aluminum, that's due March 12th, and the 2-month delay to Canada and Mexico tariffs, that supposedly happens on March 4th. Do you think any of these events register with the market?
They certainly do. The feedback I get from investors is when you think about the tariffs and those dates, they often get pushed or they often get negotiated. So they're not they're not a hard date in the sense that NVIDIA is a hard date. You know what's going to happen. You know you're going to get a data point. And that's been really difficult for investors to the point where, we've kind of seen investors say, we're going to take this reduction in tenor. We're not going to do anything until we absolutely know that this might be the day that something happens or doesn't happen. So you see a lot more of this 0-day to expiry trading as a way to manage that risk. Or you see the opposite, which is people just sitting on much longer tenors, understanding the carry that would cost, but just saying, like, I can't make some bet that it'll definitely be by April 8th, if not.
Yeah, and President Trump has perhaps conditioned us to believe that these negotiation happens and dates get moved. Amy, so great to have you on. Thank you for your time this morning. Enjoy the rest of your Friday and your weekend. Amy Wu Silverman of RBC Capital Markets. Let's get you some of the top stories now that are trending on the terminal this morning. Chinese officials are mapping out plans for tapping the nation's huge customer base. This comes as Treasury Secretary Besson prepares to refresh calls for Beijing to decrease its dependence on exports. The Chinese premier urged the improved supply of services in several industries, but did not elaborate. Officials are expected to set an ambitious growth goal of around 5% for 2025. Elsewhere in Japan, BOJ Governor Ueda warned that he was prepared to intervene in the bond market to stifle a surge in yields. He reiterated that the central bank's commitment to supporting stability, but gave little hint on whether any bond action might take place in the near term. Ueda's comments did lead to a fall in yields and a weakening of the yen. Finally, Standard Chartered said it would hand back $1.5 billion more to shareholders as it reported fourth quarter earnings that beat estimates. That was boosted by a strong performance of its trading and wealth business. The CFO spoke to Bloomberg's Anna Edwards earlier today.
First of all, let's remember that in terms of contribution to the top line, our net interest income contributes about 50%, and our non-net interest income contributes about another 50%. Non-net interest income has very strong engines of growth, up 20% last year, as we have just discussed. And in terms of net interest income, we have been building up our hedges, de-risking the delivery of net interest income, and I think that positions us well for this slightly more uncertain world.
Okay, so let's turn to the other part of that, of the income stream, and away from net interest margin and the other areas. One of the areas I want to ask you about is global markets and what you've managed to achieve there in the global markets business, getting a boost from some of the volatility in markets. It seems traders doing well on that. And that's been a story across Wall Street, across lots of the banking sector. Thing is that sustainable in any way? Do you have any visibility on whether that kind of performance is sustainable?
So I think it's sustainable for us. And the reason is that our markets business, as we often like to point out, is a peculiar type of market business. Because we are a giant connector bank, really 75% of what we do in markets is helping our clients manage their exposures to foreign currency, interest rates, and other risks. That is very recurrent activity. When volatility then spikes, we add to it performance in helping them take advantage of those market dislocations. But the delivery of our financial markets numbers is highly de-risked once again by this attractive complexion of the business, and it's business that, by the way, grows well. We pointed out at Q3 at our last set of results that this part of the business grows at almost 10% per annum, and it's been doing so for 5 years.
The Standard Chartered CFO there. Coming up on the show, the U.S. wants Ukraine to accept its minerals deal. Axios reporting that they've improved the terms. We're going to have more on that next on your Bloomberg Brief.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
about artificial intelligence. Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I do have my first call with my Chinese counterpart tomorrow morning, so I look forward to a very productive discussion.
What's the first point you want to bring up?
That we want to work together, and as we said, a lot of the precursor ingredients from fentanyl originate in China, so we really want to put a stop to that very quickly.
That was U.S. Treasury Secretary speaking to Bloomberg Surveillance yesterday. President Trump also told reporters on Air Force One earlier this week that a deal between Washington and Beijing was possible, even as tariffs are being touted and trade war talks abound. At the same time, China talking more about trying to turn their economy to consumption, something Scott Bessent and others in the Trump administration have advocated for. Joining us for more is Bloomberg's Kevin Whitelaw. Kevin, a lot for those two to talk through on a possible call. What might we expect?
Well, I think it's going to be an initial conversation and an exploration from both sides to understand what sort of the framework is here. And the question really is the Trump administration using these tariffs as a lever for a deal on fentanyl and trade and other things, or you've also seen the White House start to talk in recent days and weeks a little bit more about the revenue side of what could be generated from tariffs. And so ultimately there's going to have to be a decision within the Trump administration itself about what really is it that they're trying to accomplish with all of these various threats. Are they looking for a bunch of short-term deals? Are they looking for something that is a longer-term, sort of more structural deal? Or are they actually looking for a way to boost government revenue that simply means that tariffs are going to come in some fashion or another, whether the countries like it or not?
I got to be honest, Kevin, I feel like you could almost ask a similar, not exactly the same question, but a similar question when it comes to what the U.S. is doing with Russia and as it pertains to the war in Ukraine. Does it seem at this moment that the conversations happening with Russia, Scott Bessent yesterday also bringing up the potential use of sanctions for this war in Ukraine, something to extract economic gain for the U.S. and Russian relations, or really as a tool to help end and get the best deal possible in the war in Ukraine?
Well, that's right. And you're hearing it both with the Ukraine side as well as with the Russia side. So obviously we've talked about the possibility of, Trump has talked about trying to strike a deal with Ukraine on critical minerals. He has also floated the idea of essentially improving and softening relations with Russia. And so, yeah, again, the same thing is a question of how much of this is really aimed at simply trying to get a win, i.e. a ceasefire deal, something that Trump did campaign on and promise, saying that he could end the war in Ukraine, and how much of this is about sort of some kind of promise beyond that, whether it is related to Russia's various, mineral and energy resources, or whether it's actually about Ukraine's. And so, to some degree, Trump is shaking up the conversation. He's forcing both sides to take a negotiation more seriously than they might have otherwise But, you know, what is he really looking for? I still think we're still trying to understand that, frankly.
And Kevin, just want to wrap it up because Senate Republicans do appear to have adopted a narrower budget proposal after the vote-a-rama of last night going into the early hours of this morning. Democrats really attempting to pin Republicans down on certain votes, hence also why the thing takes as long as it does. What is the outcome of this? Republicans pass a skinnier version, but Trump, of course, has backed the House version of the bill.
Yeah, I mean, obviously, both, there's complications in both chambers as they try to figure out how to accommodate what Trump says he wants. An extremely slim majority in the House, and obviously complications in the Senate, where a number of senators have to worry about either their own reelection prospects or have their own views that they feel need to be taken into account. And what Trump has been talking about really would obviously be a pretty significant restructuring, and there is a lot of deep concern over what kind of backlash that could mean for some Republicans as they have to start already turning their attentions toward the midterm elections in less than 2 years.
Kevin, thank you as always. That is Bloomberg's Brussels Bureau Chief Kevin Whitelaw, who of course has an extensive background reporting in D.C. as well. Now some corporate news for you. Shares of Nissan getting a boost in the latest session in Tokyo after a report from the FT suggested that a Japanese group has drawn up plans to seek investment from Tesla to support the firm. Those shares closing higher by 9.5%. Let's get more with Bloomberg's Craig Trudell. So, Craig, this firm might be drawing up plans, but is this something Tesla might actually do?
Yeah, the group here includes a former prime minister in Japan and also a former director on Tesla's board who used to run Japan's pension fund. So sort of on the surface with those characters involved, you have to take this seriously. But I do have to kind of wonder, just what the likelihood is that this gets as far off the ground as Nissan's attempt to combine with Honda got off the ground, which is to say not very far at all. When you sort of take a step back and think about, what Elon Musk would do if, put at the controls of Nissan, I think it's hard to fathom how, how Japanese factories and Japanese jobs would be protected given, what we've seen Musk do, not just in Washington of late, but also at his companies of late. Tesla, slashed its workforce, globally last year. And this is someone who is a sort of ruthless operator. That may be what Nissan needs, but I think we've seen that Nissan's management and board is quite reluctant to do the sort of things that Musk would presumably want to do here.
Greg, we're also just getting some lines from Nikkei this morning that Foxconn has also proposed a partnership with Honda. When it comes to Honda and Nissan, how important is it that these companies find partners? How difficult will it be for them to continue on alone as it is?
I think Honda's a much healthier company and, is worth many multiples of Nissan. I think the question really is Nissan and its future and, whether or not if it can continue as its own company. We've seen, Moody's just overnight, cut their credit rating on Nissan. This is a company that, again, was trying to combine with Honda, and there were sort of culture clashes there. You want to sort of, again, go back to this FT story. If Nissan can't overcome culture clashes with a fellow Japanese manufacturer in Honda, you have to sort of wonder what the likelihood is that they could get along with Tesla and Elon Musk. But, I do think that there are real concerns about, the trajectory of Nissan, its performance, the state of its lineup, and that's really what you heard Moody's talk about in their downgrade was this is a company that its earnings power is severely, degraded. The lineup is dated, and they have real issues in front of them in terms of trade policies. Of course, the Trump administration has long been hawkish on Japan and Japanese cars. That is, something that this company, can ill afford at this point, given the state of affairs.
Craig, I was going to say, is there some degree recording Elon Musk is also a way to politically insulate themselves?
Yeah, I mean, I think that's part of what makes this FT report intriguing. the idea here, apparently among this group of people who want to put these companies together, is that Tesla could tap into Nissan's U.S. factories and add to its capacity. I think we heard, saw from Musk in reaction to this report. He sent out this sort of cryptic post on X about the idea that Tesla's factories are its product, and I think the sort of easiest interpretation there is maybe Nissan's factories would not be of use to him if he sort of views Tesla's plants as superior and his production methods as superior to Nissan's. Perhaps he wouldn't have an interest in taking on this troubled company as a result of that.
Craig, thank you so much. Bloomberg's Craig Trudell there. Coming up, Francine Lacqua is going to be taking you through your day ahead. Next, I'm going to head over to the surveillance studio. We will see you shortly. This is your Bloomberg Brief.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. Bloomberg brings you breaking news 24 hours a day. Powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
This is Bloomberg Brief. I'm Francine Lacqua here in London, and here's a look at what's ahead today. Through the weekend, U.S. PMI coming in at 9:45 a.m. Eastern Time, followed by a revised reading of the University of Michigan Consumer Sentiment. That's at 10 a.m. Then more Fed speak from the Vice Chair, Philip Jefferson, at 11:30 a.m. And then, of course, on Saturday, Berkshire Hathaway reports its fourth quarter earnings. Now, a couple of things we're watching out for. Alibaba extending its post-earnings gains. Reported sales that beat estimates, driven by the core Taobao and Tmall business. Block also falling after fourth quarter results actually miss estimates, down some 7.27%. And finally, Rivian also declining after its results, given some of the downbeat vehicle delivery forecasts. These are what stocks are doing. The one I'm actually watching out for is probably gold. Gold headed for an 8th consecutive weekly advance. Again, this is amid all of these geopolitical and trade tensions. That's it for the Bloomberg Brief. Surveillance is up ahead. Context matters on Bloomberg.
also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me. And I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Everything that President Trump's administration is doing will be disinflationary.
Our view is that once tariffs kick in, they'll be more inflationary than the market expects.
Any real deficit reduction that we may see under this administration is likely going to be a 2026 story.
Stocks basically are pricing that the tariffs are a bluff and growth is going to be great. The odds look skewed in the other direction.
It's clear that the market is focused almost entirely on inflation risk.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P almost totally unchanged. On the Nasdaq 100, shaping up as follows. We're positive by about 1/10%. In the bond market, a little bit stronger yesterday. Yields a little bit lower this morning. Same again. We're down about a basis point or two on a 10-year to 4.4896. A couple of data points to look out for later this morning. 9:45 Eastern Time, US PMIs. Then after that, 10 a.m., UMich consumer confidence, consumer sentiment in focus.
It is in focus because last month, remember, dropped to a 7-month low. And it's in focus as well because we are 1 month into this administration and the polling's coming out. How is Trump doing first month in? CNN, SSR poll, majority of Americans, 62%, think this administration's not doing enough to lower everyday goods. Now, how can they do enough in 30 days? It's going to be very challenging. But then you start creeping into some of the surveys, the concern about tariffs. And even if it's a one hit to prices, it's still going to mean higher prices.
Danny Berger alongside us this morning. Danny, good morning. Last week it was retail sales softer. Yesterday it was Walmart. A weak outlook.
And Walmart taking down the entirety of the market with it. You're starting to see creeping into markets, not that much because we are just coming off of record highs, but this concern about growth. You can see it in the long end of bonds too. Sure, it moved yesterday on your fantastic interview with Scott Besson, this idea that they're not necessarily going to rush to term out the debt. But Stephen Major of HSBC says also in the 10-year yields is this idea that growth will be weaker going forward. That's underscored by Walmart and has serious implications for this equity market, which again is trading at all-time highs.
We've got some Fed speak later on today as well. You'll hear from the San Francisco Fed President Mary Daly alongside the Vice Chair Philip Jefferson. Look out for that. We heard from President Muslim yesterday. The risk of inflation stalling above 2% or moving higher seems skewed to the upside. So the market focused potentially on downside risk to growth. Fed officials focus on upside risk to inflation. That's not a great place to be.
It's not a great place to be, and it's what we saw in the minutes as well. Some participants are concerned about the policy uncertainty in Washington, D.C., the fact that tariffs might be inflationary. Even if you want to look through them, there will be this potential one hit. And also changes in immigration. Is that going to affect the labor market, potentially making a wages spike because you're taking some individuals out of hospitality and other sectors? So there is this concern at the Fed, which means basically they can't cut.
I also thought what was really interesting in what Muslim said yesterday was this idea that a restrictive path, more restrictive path might be necessary if those inflation expectations get more anchored. It's starting to see the idea, not of hikes. We don't know whether he meant hikes or just keep things as they are, but he started to kind of say it, and you get this idea almost that the Fed can't give guidance right now. They can't do it. Bostic saying his opinion might change in 6 months from now. They have no idea what's going to happen.
The Fed can't and companies can't either. They're all in the same position. Equity futures right now on the S&P just about unchanged. Bond yields a touch lower. Coming up this hour, we'll catch up with Steve Chevron of Federated Hermes as stocks fall from all-time highs. Rob Casey of Signum as the White House says tariff revenue could replace income tax. And Kelsey Barrow of JP Morgan Asset Management as Secretary Besson says terming out U.S. debt is a long way off. We begin this hour with stock steady. Steve Chevron of Federated staying optimistic, writing this: our view remains unchanged. A volatile, choppy and uncertain first half of the year will give way to a push higher in the second half as inflation grinds lower and companies beat and raise against conservative guidance. Steve joins us now for more. Steve, good morning, sir. That's about 3 or 4 minutes of bearishness, so let's park that. Tell us why we should be constructive for the year ahead.
Well, I think what you've done is you've replaced some euphoria late in the fourth quarter with a nice kind of healthy wall of worry. And you see it on your opening segment that we're in this fog of uncertainty. You know, are we more worried about inflation? Are we more worried about growth? You know, and I think the story here is if you stay anchored on the fundamentals, John, GDP is still growing 2.5%. Inflation is lower than it's been. It's sticky here in this kind of 2.5 to 3 neighborhood, but it's certainly not resurging at this point. And corporate earnings are growing 12.5% this quarter, and we're setting up with a conservative guide. So I think you can get yourself worried sick over the cross currents right now, and you just end up whipsawing yourself as opposed to saying, if labor markets are strong, inflation's grinding lower, even at a slow pace, it's not a bad place to be.
Steve, there's always something to worry about. Pick a year, any year. There's always something to worry about. Does the fog clear at any point this year? I heard from BMO's Ian Lincoln in the last couple of days, and Ian was making the argument that maybe for the whole of the first half, we'll be focused on these things: upside risk to inflation, tariffs. Then in the second half, maybe some of this clears. Do you share that view?
Yeah, I think you got to take the wall of worry down kind of brick by brick. So, you know, we have seen excess seasonality in inflation data the last couple of years in this early part of the year. So, you know, we expect that as you get into the spring months, you'll start to see that inflation come down. Look, if DOGE is really going to lead to as many kind of separations of government jobs as we're seeing, whether those are layoffs or firings or departments closing, and you start to see claims move up a little bit, then I think you're going to see the Fed change their tune very, very quickly. So you could see rate cuts start to come back into focus. I think, you know, this tariff issue, especially as we get into that April-May period, it looks like we'll get some more clarity there. And then once you get to Memorial Day, at least that's the plan at this point, you get that quote-unquote big, beautiful bill out of Washington, you're going to start to remove a good chunk of that uncertainty. So I think it is going to take time. I think we're in this period of uncertainty for most of the first half. But you can start to see kind of late spring, early summer, the opportunity to start to peel away some of that uncertainty. And I think markets have been resilient so far and maybe more than resilient in the second half.
Is there any degree, Steve, where having a first half of uncertainty can do damage if you have companies who are uncertain that maybe hire less, do capital expenditures? Do any scars of that carry over even when we do get more details?
Yeah, I think they can. And if you think about it, we have 4 kind of major money centers in the U.S. You have finance in New York, you have tech out in California, you have energy in Texas, and you have politics in Washington. And we know that you can have a Texas energy recession and the rest of the economy does well because it lowers costs for everyone else. What we haven't really tested, and I think we may over the course of this year, is can you have a Washington recession and have the rest of the economy power through? If less government spending and economic activity in that area leads to a little bit more money in the pocket of the rest of the country, I think that's possible. So, you know, while the DOGE dividend is certainly an interesting alliteration, it may matter. And I think that's going to be one of the tests. Can you shrink Washington in a kind of structural reform way and still have that benefit the rest of the economy over the short run. And I think we're about to find out.
How are you thinking about what that shrink to Washington, the ramifications of it? Because it's not just federal workers. There's maybe concern among state employees that they could be hit in various places in the country. There's concern for contractors who aren't directly employed by the federal government. How are you thinking about that holistic picture?
Well, I think when you see the minutes from yesterday and you hear some of the Fed speak being as focused on inflation as it is, I feel like they're fighting, the battle of 3 or 4 months ago. I think the single most important economic data point right now is unemployment claims and what's going to happen to those claims, because it's not just the government workers themselves that are potentially being laid off. But I mean, one of the things we saw from USAID, forget about what your opinion is on what that spending was, is that there's a lot of NGOs out there that probably don't exist without that funding. We've seen the reaction of some of the defense stocks on this idea of an 8% budget cut. And so I think what's happening here, and this is really important, I think this was the around that noise around the Mar-a-Lago Accord rumors as well, is we are leaving this Keynesian world of either the government spends and it's stimulus or they cut and it's restrictive. And we're entering a world of structural reform, and that could be bigger and it could have more tentacles through the economy as industries, companies that are reliant on the government come under pressure. And so to me, where you're going to see that is in unemployment claims. And is that localized to DC? Is it a manageable number? Or do you start to see that spread through the economy? And that's what you need to watch. So for me, I think that the Fed's concern about inflation right now is a little bit rear view mirror. I think what you need to focus on is what are these policies in the short run, even if they're positive in the long run, going to mean to growth over the next, several months?
Well, Steve, you asked the question in your note, can the U.S. weather a Washington recession?
I think it's possible that you can. If you think about a New York recession or a California recession, if you will, when Wall Street comes under pressure, there's no offsetting balance to the rest of the consumer base. It doesn't help. It doesn't make things cheaper. It doesn't return money to the taxpayer. Same thing with California and tech. Now, in Texas, when they're under pressure because oil prices are lower, there's a lower price kind of mechanism that benefits the rest of the economy. And so the question here is if you really are cutting government spending and employment, is there an offsetting benefit to the rest of the economy? And if that means lower taxes and or lower borrowing rates, which I know Scott Besson is talking about and targeting directly, then it can. So it's not a shoo-in, but I think this is a candidate for one where, if Washington's pain is the gain of the rest of the economy, then you can, but we still have to see. That's going to be the part of the uncertainty of this first half.
Another piece of uncertainty, and I know it's just a proposal right now, but they are talking about these Doge dividends, $5,000 checks going out to the rest of the country. To your point, take away from some of Washington, but put out to the rest of the nation. Do you think those would be inflationary?
No, they can't be. If they're being funded by cuts, right? If I cut a chunk of spending and then I return 20% of it back to the taxpayer, it can't be inflationary in the short run because I've already pre-cut that money, right? I'm just shifting it from one part of the economy to the other. And over the long run, the idea is that the private individual is going to use that money in a much more productive way than the government would have. So no, I mean, there's a lot of things that are being thrown out, like tariffs being inflationary. They're not, and you have to look at that offset against, how much activity are you cutting out of Washington? How many jobs are being lost? You see what's happening with some of the real estate prices there. So no, taking from the government and giving back to the people, it might be disinflationary for the government and a little bit inflationary for the private economy, but it is not inflationary. I think people need to remember inflation is a persistent upward cycle in prices because you're putting too money after too few goods. And I don't see how taking it from the government and giving it to private individuals does that.
A lot of people would say, we'll take that. Steve, appreciate it. Have a good weekend. Steve Chevron there at Federated Hermes. I've seen this argument now in notes from Citi, in notes from BMO. There's a big focus on Doge and spending cuts. I mentioned Ian Lingen in a note yesterday. He said, our concern is that one, cuts will be deeper. Two, government contractors will be the next sector to seek to rationalise labour force size. And three, the outlook for the broader jobs market will finally dim on increased uncertainty. Now, we didn't see this at the headline level in jobless claims, but I think increasingly market participants very focused focused on that number week after week.
And especially September, a number of individuals decided to defer getting basically laid off, but taking this buyout to September. So potentially we won't see the full picture to the end of the year, but you have to think in 2024, every month, the average when it comes to federal workers adding to the NFP number was about 34,000 people. How much lower is it going to be every single month once we have DOGE clear through the government?
It could become a factor, that's for sure. More data later on this morning, 9:45 Eastern time. We'll get some manufacturing and services PMIs for you. Then shortly after that, UMich Consumer Confidence. That sentiment survey comes out as well. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. Israel's military says Hamas has violated the Gaza ceasefire deal by handing over an anonymous body instead of one of the hostages. The IDF says the remains they were given were not those of Shiri Bibas, who was captured alongside her two sons in the October 7th attacks. Hamas is due to free 6 living hostages tomorrow. UK retail sales grew 1.7% in January, exceeding expectations. The rise was driven by consumers spending more on food to eat at home. Food sales were the strongest since the start of the pandemic in March 2020. However, consumers are still cautious with decreases in other categories and confidence remaining weak. And Rivian shares are falling some 5% in the pre-market after the EV maker issued a disappointing vehicle delivery forecast. That development overshadowing its first ever quarterly gross profit. They're warning that changes to tariffs, EV tax credits, and regulatory policies out of Washington could impact sales. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. More from Yahara later on this hour. Up next on the program, tariffs replacing taxes.
President Trump has spoken about replacing income tax with tariff revenue, especially with all this waste, fraud, and abuse that we're seeing cut. Is that a possibility?
Absolutely. And in fact, if you think about the China tariff revenue that we're estimating is coming in from the 10% that we just added, plus the de minimis thing, that it's between $500 billion and $1 trillion over 10 years is our estimate. And so we expect that the tariff revenue is actually going to make it much easier for Republicans to pass a bill, and that was the president's plan all along.
That conversation up next with Rob Casey of Signum Global Advisors from New York City this morning, taking you into the weekend with equity futures just about unchanged. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Equity futures right now on the S&P 500 just about unchanged. In the bond market, yields lower yesterday, down this morning by about a basis point on a 10-year. We're very, very close to a 6th consecutive week of declining 10-year yields on the week so far. Just about unchanged. That's something to look for going into the weekend. And the surveillance this morning, tariffs replacing taxes.
President Trump has spoken about replacing income tax with tariff revenue, especially with all this waste, fraud, and abuse that we're seeing cut. Is that a possibility?
Absolutely. And in fact, if you think about the China tariff revenue that we're estimating is coming in from the 10% that we just added, plus the de minimis thing, that it's between $500 billion and $1 trillion over 10 years is our estimate. And so we expect that the tariff revenue is actually going to make it much easier for Republicans to pass a bill, and that was the president's plan all along.
So here's the latest this morning. National Economic Council Director Kevin Hassett telling reporters that tariff revenue could replace income tax as part of President Trump's economic plan. Rob Casey of Signum Global Advisors joins us now for more. Rob, I think we'll all take that, won't we? Is it going to happen?
Yeah, it sounds good to me. No income tax. No, I don't think it's going to happen. Even if we look at maximalist numbers, 10% universal, 60% tariff on China, which, to be clear, we have not seen yet, and is not our base case at Signum. We get to between 10 and 15% of income tax revenue per year. So we're not even close.
Well, Howard Lutnick, the new Commerce Secretary, even said that the IRS should be abolished. How maximalist can we see the Trump administration go when it comes to tax reform?
Well, when it comes to tax reform, they're certainly working hard, right? And they're in particular working hard with Speaker Johnson and the House Republican Conference. They want to get tax reform done early and in one big bill. When it comes to the IRS, we've heard that from Republicans for quite a long time. Obviously, President Biden beefed up the IRS during his term, and I expect to see that sort of beefing up rescinded and pulled back. But I think 4 years from now, we will still have an IRS, much to the rest of our chagrin.
So when it comes to the tax bill they're trying to get through, how much will the tariffs actually offset? And then where do they need to look elsewhere for the offset of the cuts?
Yeah, so, I mean, when we're thinking like super broadly, right, if Republicans are trying to make the political message, the rhetorical message that tariffs can offset part of the agenda, I mean, and we see whether it's, a 10% universal tariff or similar, that looks like in the ballpark of $100 billion plus per year, right? Like that's not nothing. The thing is, those aren't the tariff plans that we've seen so far, right? We're talking about autos, we're talking about steel and aluminum. That's not universal, and it's certainly not 60% on China. And then secondly, and potentially more importantly, Republicans want to extend the TCJA tax cuts permanently, right, ad infinitum, not just over 6 or 8 or 10 years. To do that, they have to pay for the whole thing, which looks like $4.5, maybe even $5 trillion. And so they would have to write tariffs at that level into the reconciliation bill, right? And there's no conversation in D.C. about actually writing the tariffs into a congressional package. So they can talk about some of the offsets, but it's not going to work.
You mentioned TCJA. This is just the base case, extending it. What else are they going to put in this tax bill? Because Trump has had tons of provisions he's discussed, whether it's no tax on tip, no tax on Social Security. What else gets added?
Well, I think no tax on tips over the course of the past week is clearly President Trump's favorite policy, right? His priority #1 agenda, in addition to extending TCJA. The House bill, as it currently stands, allows for $4.5 trillion in quote-unquote spending on tax, right? Maybe they fit no tax on tips in there, but it's going to be really tight, right? It's just simple extension of TCJA looks like $4.2, $4.3 trillion over 10 years. So, I mean, I think it is an open question as to what else they're going to be able to include. It seems like no tax on tips is #1 priority. I mean, Jonathan was just saying that they've got to include something new, right? President Trump was elected to cut taxes further. But honestly, our base case is, we wind up getting 2 reconciliation bills, one early and one on tax late. And the tax package actually looks relatively narrow.
Well, we had some movement in the Senate yesterday with the vote-a-rama going through the early hours, seemingly getting through a slimmed-down version. How does that progression look in compared to what we might get from the House? The big, beautiful bill versus something that looks a bit skinnier.
Yeah, so after Donald Trump came out and said that he would prefer one big, beautiful bill, right, which I don't think we can blame him for. If I'm president, I want one big, beautiful bill too, right? Like get everything.
One signature.
Yeah, exactly. If you can get all my priorities done in the next month, great, I'll take it. But what Lindsey Graham has said, and I think what Senate Republicans realize, is that in Congress, especially with these as slim a majority in the House as Republicans have, you need a plan B, right? So I don't doubt the president's sincerity or Speaker Johnson's belief that a one bill package is better and potentially a necessity, but I do doubt that they're going to be able to get it done, right? And so now a week or a month or even 2 months from now, when they have failed to get that package through, both because the House Freedom Caucus is potentially upset that there aren't more spending cuts, and also because moderate Republicans, particularly in New York, are worried about things like Medicaid cuts, right? At that point, we will then be looking towards the Senate bill, which, Danny, to your point, is already making its way through the Senate as a plan B, and we'll deal with tax in Q4, and maybe the markets worry about that, but I think it gets done.
Well, to the point of Medicaid cuts, you did have this effort from Democrats trying to pin down various members and voting on those sorts of things. You see that effort for them. You see efforts of ideas of maybe a government shutdown would be something pushed by the Democrats. What do you make of their messaging at this time?
Well, messaging or lack thereof, right?
Yeah.
I think for Democrats, they have yet to hit on a great strategy to counter Trump, either politically or legally, and also rhetorically in the public eye. So it is our base case at Signum that we will see a government shutdown on March 14th into March 15th. It's like the one lever of power that Democrats are going to be able to wield in the short term. But otherwise, I was just talking to a Democratic senator last night who said not only do Democrats need a positive message, they need a consistent messenger. And the challenge for Democrats is any single consistent messenger looks like the front runner for the presidency in 4 years. And so there will be 40 other Democrats who are going to poke and prod that person over the course of the next 4 years. So that's a real challenge. But at least Democrats are talking about the need for not only a message, but a messenger.
They're very unhappy with some of the work that Doge is doing, but this market increasingly is focused on it. Spending cuts. We saw that report from the Washington Post earlier this week about defense spending and what that did to some defense stocks. We've been talking about that at the top of the program. The other focus as well is what it does to jobs. I mentioned BMO earlier, the quote from them that the cuts might be deeper. Government contractors will be the next sector to seek to rationalize their labor force. The outlook for broader jobs market could actually dim from here. What is your assessment alongside your team on how deep these cuts might be?
So I think that they will be less deep than they look today, right? Because what we're hearing from D.C. is sort of Donald Trump and Elon Musk have the prerogative to pause all of this spending across the board, right? And a lot of it looks like cuts today. But, in reality, a month or 6 months from now, a lot of that spending will get restarted, right? So if we're thinking about things like, nuclear protection, if we're thinking about things like cancer research, if we're thinking about things like DOD, right? It's a pause, and it is Donald Trump's prerogative to say, we want to know where this money is going and why this money is being spent. But I think for the most part, a lot of that money is going to get restarted over time.
Rob, appreciate it. It's good to see you, sir. As always, Rob Casey of Signum Global Advisors. A lot of people in this market becoming laser focused on jobless claims week by week.
Yeah, because the federal workforce is a massive issuance and add additional of jobs to this market, $35,000 a month, 35,000 people a month for NFP. So this is going to be potentially huge holes.
Up next on the program, we've got a big headline for you. The gold is in Fort Knox. It's there, apparently, according to Secretary Besson. In just a moment, we'll catch up with Francisco Blanch of Bank of America Securities with gold on track for an 8th consecutive weekly advance. The longest weekly streak, I think, going all the way back to 2020. Unbelievable. Gold this morning, just about negative by 1/10 of 1%, 29.34. More on the commodity market in just a moment. Live from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but I can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're going to do it for fun.
Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
The S&P 500 barely green on the week so far, going into the weekend, and this morning kind of the same, barely green again, just about positive on the session and just about positive on the week so far. On the Nasdaq 100, positive by 0.1% this morning. On the Russell, the small caps up by a third. In the bond market, the 2-year has been incredibly anchored. The 2-year at the moment down a basis point today and just about unchanged on the week. 425.76. The 10-year, all the talk about Secretary Bessent. Thank you very much for all the input you had yesterday to our conversation with the Treasury Secretary, not terming out the debt anytime soon.
And the bond market liked that, and off to the races we went. We were able to rally. That rally, though, somewhat contained because of the uncertainty. It's something that keeps coming up over and over again. But what it has meant for all those people who came into 2025 said it's going to be steepeners, it's going to be the 2-year yield that comes down and the long end that goes up because of inflation, they have been proven wrong. It's been exactly the opposite.
We mentioned it yesterday. Yields have actually fallen every week so far of the Trump presidency. Might change this week. Still got one more session to go, but that's been the trend, the theme of the last month or so. Want to finish on foreign exchange. Had some data out of Europe, some PMIs, and they really were not great, particularly out of France. Euro dollar negative by a third of 1%. Danny, 104.69.
It's a painful time for this euro, but you have to ask, with this bad data in hand, with German elections coming this weekend, is all the bad stuff already in there? Perhaps the bigger risk is for a surprise to the upside, much like we saw with European equities. There's just so much negativity in Europe right now, from tariffs to defense spending. Perhaps the move of direction could be a surprise this weekend, a leader coming out of Europe. Again, the expectations are not for that, but everyone is just so dire and dour on both bonds and currencies in Europe.
Bloomberg's Ollie Crook leading our coverage out of Berlin over the weekend. Look out for that on Sunday. On our radar this morning, Chinese officials are formulating plans to tap into the country's massive customer base. The Chinese premier urging the cabinet to vigorously improve the supply of services across several major sectors. The move coming as U.S. Treasury Secretary Scott Bessent told us yesterday that he would like China to rebalance away from export-led growth.
He wants that growth to come domestically. He wants Chinese consumers to buy Chinese goods and doesn't want to see dumping on the market. And he's going to have a phone call with his counterpart this morning, He Feng. This is who Janet Yellen also dealt with. I think this is an important conversation. According to Scott Bessent yesterday, both these men are not attending the G20 finance ministers meeting next week in South Africa. So the first time they're actually going to meet face-to-face is going to be at the spring meetings. But this is the two most important economies. At the same time, we haven't seen that conversation between Trump and Xi since the tariffs went on. So this is going to be an important one.
This also underscores to me that China is doing a lot of things that people in the West thought that they would not do. Now, they stopped short of giving any direct subsidies to people to try to spur consumption, but it is a focus on consumption. That maybe caught us by surprise. Also, an embrace of private tech, that also caught us by surprise. I think a lot of people owe David Tepper an apology for being so bullish on China and everyone kind of brushing that aside, but it has worked because of this renewed focus, again, both on the private sector and on consumption.
K-Web has performed really well. Baba this morning performing nicely as well. DeepSeek, of course, a big shake-up from that company in the past few weeks. We mentioned the European election over in Germany. German Chancellor Olaf Scholz and Conservative front-runner Friedrich Merz making their final pitches to voters ahead of Sunday's snap election. Polls so far showing Merz in the lead. This is French President Emmanuel Macron is set to visit President Trump in D.C. just next week. Macron, of course, likely to defend European interests around the war in Ukraine.
I think Danny nailed it when she said maybe this weekend we'll see there's going to be a leader in Europe. Well, Germany is going to be a fractious government regardless of who leads in the polls, and Macron is trying to step up to the plate to be the interlocutor between Europe and the United States. And he says he's going to have a message to Donald Trump when he visits him on Monday. I'm going to tell him that he can't be weak in the face of Vladimir Putin. This is coming at a time when we've seen a lot of acrimony between Zelensky and Donald Trump.
I think if you do get a strong lead showing from the CDU, you do get a leader out of Germany to be kind of the quote-unquote leader of Europe, it could make a huge difference. Because we're talking about joint issuance from the EU right now. I think there are very few Europeans who would be willing to cede their fiscal authority to Brussels. But if you have someone like Germany leading the charge, and Germany the one going to Brussels trying to get that done, it could be a very different conversation.
Watch this space this weekend. We'll see what we get when we wake up on Monday morning. Wanted to fit this story in. Another big change from another big bank. Citi is ending workplace DEI goals and removing requirements to interview job applicants from diverse backgrounds. Bloomberg obtaining a memo saying the bank is dropping the policy, citing pressure from the Trump administration.
So not really directly saying this is Trump, but this was the line. It's important to note that we're living in an environment where things are changing quickly. We'll determine if additional updates are needed to other areas in the coming weeks. The question I have is, okay, Citi's doing what everyone else seems to be doing. Who isn't changing their DEI at their companies right now, given that changing environment?
Well, it's even to the point, I was reading an interview with the bank Citi's global head of talent literally 2 months ago. Let me just say the quote from this. DEI is a, quote, business imperative and part of our DNA. That was literally 2 months ago. I think we have this problem with corporations just assuming that they're going to be the arbiters of social responsibility and social change. I think we're getting this reality check over and over that they are corporations, they have a product to sell, and they need to follow the lay of the land.
So step one was virtue signaling. And I'm going to push Citi to one side. I'm not naming a company here. Step one was virtue signaling. Step two was a tap on the shoulder from the legal department. That's what this is all about. The lawyers have got in touch with them and told them, you can't do this, you can't do that. I see nothing else here.
Well, Pam Bondi, even the Attorney General, issued a memo essentially saying we're going to start doing criminal investigations on DEI policy. If that doesn't wake up the legal department, I don't know what does. There has to be some element, okay, you can continue to have diversity through your ranks. Maybe just call it by something else. Maybe don't have this big outwardly kind of virtue signaling of you're doing something wonderful for the world.
The lawyers are winning and HR is taking a backseat.
Without a doubt, it's a great way of summing things up, and I imagine there's more still to come, that's for sure. Let's turn back to the commodity market and talk about gold. The Treasury Secretary, Scott Bessent, weighing in on recent speculation.
Elon Musk, who's leading Doge, was talking about maybe going to Fort Knox to make sure those gold reserves are there. That comes under your purview. Do you have any plans to visit Kentucky?
All the gold is there. Any U.S. senator who wants to come and visit it can arrange a visit through our office.
All the gold is there. Gold pulling back slightly from all-time highs. Here's the take from Francisco Blanch of Bank of America. We've been bullish gold for the best part of 2 years and first published our $3,000 per ounce price target back in June 2024. Francisco joins us now for more. Francisco, we're around 3K, around those levels right now. Can we just start with some of the conspiracy theories out there at the moment? Maybe they're not conspiracy theories. I want your thoughts on Fort Knox and where some of this buzz is coming from.
Well, I really don't know how people come up with these things. You know, it's kind of a social media frenzy probably. But look, I mean, we've heard it from the U.S. government. The gold's there, and will they need an audit? Will they want to have an audit? I don't know, but certainly those 8,000 tons of gold have been there for a very long time, and the U.S. government hasn't really changed its policy on gold holdings for decades, right? So. So I think the market is confident the gold's there.
When you speak to clients, Francisco, have you got a decent read on why we're seeing some of the movement we're seeing? We've seen lots of reports about gold shifting from the United Kingdom over to the United States and being taken out of the vaults of the Bank of England. What is going on there? What's behind that?
Well, there's a couple different things. There's, as you know, there's been a strong demand for gold from investors as a result of a lot of the policy changes we've seen in recent weeks and months. But also is the fact that tariffs could be applied on gold. So the U.S. gold market, COMEX, trades on a net basis of the tariffs. So what we've seen is forward points in the gold market have essentially started to reflect some of that. And also we've seen shippers trying to move gold from London, where the biggest market sits. The London bullion market is the biggest in the world, and we've seen that physical arrangement to push gold out of the UK particularly into the US market. That's been what's been shifting the shape of the gold forward market, but also I think the uncertainty around how things will play out. Gold's becoming, I think, more and more a core tenet of portfolios, and frankly, one of the few assets that has been providing diversification to equities and bonds. And I think that's the story. So we've seen, ironically, some backwardation kind of building back into the market. Not yet, but in the past it's happened. It happened during COVID. It happened during the great financial crisis. So could we see it again if tariffs kick in? It's possible.
Francisco, as someone who personally tried to visit the gold vaults in the UK and was rejected and told I couldn't, I feel personally invested in this story. A physical arbitrage like this, how long can it continue, this sort of dislocation in the market?
It can go on for a while. I have also visited the New York Fed Vault, and I did see a lot of gold when I was there 25 years ago. So I actually didn't get rejected. So just as a little anecdote, it was during my associate program back in the day. But I think the arbitrage can go on for a while until there's certainty on what will happen to tariffs, right? And to me, I mean, the whole tariff discussion is very much one tool to put pressure on certain political goals. So as long as the Trump administration feels they can use tariffs as leverage, they'll continue to use them, and therefore the gold market could still be tight for several months, I think.
That gold you saw, that's the gold of the BOE and other central banks, right? The Federal Reserve gold is other central banks, and our gold, the U.S., is in Fort Knox. So interesting there, where all this gold is stored around the United States. We also spoke to the Treasury Secretary about this idea about monetizing the balance sheet. Many people thought he meant maybe actually remarking U.S. gold. Now, he said that's not what he meant. But what if they did do that? What would that mean for the price reaction?
It's hard to say. I mean, but I think remarking U.S. gold is an accounting exercise for the most part. But it would certainly increase the Fed's balance sheet quite a bit, because that gold is marked at a very low price, as you know. So it would effectively boost the Fed balance sheet, and it would change the composition of it, at least on an accounting basis. I think it would probably be bullish for the gold market, because it would show that gold is no longer this barbarous relic that has been sitting on central banks and been dismissed a little bit. But now even the biggest central bank of them all is taking a renewed interest in gold. So certainly I think any renewed attention will be constructive for the market. That's my initial reaction.
If it's constructive for the market, and we do know this administration likes to be creative, would you take it off the table?
Yeah, it's possible they take it off the table. I mean, I'm not sure why you want to boost the gold price at this point. I think what the U.S. government is really trying to do is lower energy prices, so inflation can continue to normalize and allow for lower interest rates. But I think they're also trying to weaken the U.S. dollar. I'm not sure how bringing attention into the gold market is going to help any of those two goals. So bringing down inflation, or three goals, right? Bringing down inflation, bringing down interest rates, and eventually weakening the U.S. dollar, which is, as you know, at record high levels or near record high levels.
Francisco, let's pick up on that last point. Bring it down energy prices. How can they go about doing so?
Well, we've seen this past couple of weeks has been fascinating to watch, right? We've had a meeting earlier in the week in Saudi Arabia Russia and the U.S. These are the world's three largest oil producers by a long stretch. And you can't help think that energy has been part of the discussions. I think that last third goal that Secretary Rubio mentioned in his comments of potentially engaging in some economic cooperation with Russia was a bit of a surprise to many, because European companies, U.S. companies have been pulling out of Russia for the last 3 years, or trying to pull out of Russia for the most part. So what does economic cooperation mean? In what format? Ultimately, Russia is a commodities producer, mostly an energy producer. So any cooperation is going to come on the energy front. So we know that President Trump wants to lower energy prices. Is that part of the deal? I don't know, but for sure, something that's been brought up in the conversations. How does the U.S. bring down global energy prices? How does that impact the inflation picture? And also remember, there's potentially an angle here, which is if Russia eventually gets sanctions relief, does that mean that we have a new stream of petrodollars flowing into the market? And are those petrodollars potentially as well a source of funding for the U.S. government down the line, as we see kind of this constant need to fill that $2 trillion budget deficit in Washington?
It's got our attention, that's for sure. Francisco, thank you, sir. Francisco Blanch there of Bank of America on the commodity market, first on gold and then on crude. Brent crude this morning down by about 8 or 9/10%. Brent at 75.83. WTI just short of 72. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. The Washington Post is reporting President Donald Trump is planning an executive order this week to fire the board at the U.S. Postal Service. The Post says his plan is to fold the agency into the Commerce Department under Secretary Howard Lutnick. According to the report, the board is prepared to sue if the president threatens its independence. Meanwhile, shares of Nissan traded higher in Japan today. The Financial Times reporting that a high-level Japanese group has drawn up plans to seek investment from Elon Musk's Tesla. The paper says the group believes the electric vehicle maker is interested in acquiring Nissan's plants in the U.S. And shares of Celsius Holding are soaring 30% in the pre-market after it announced plans to buy rival energy drink maker Alani Nu for $1.8 billion. The deal is expected to close in the second quarter of 2025. It comes as Celsius revenue growth has slowed due to increasing competition in the space. That's the Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, calming words for the bond market.
The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
It's not happening anytime soon. We'll catch up with Kelsey Barrow of JP Morgan Asset Management in just a moment. From New York, you're watching Bloomberg TV.
In case you missed it, from Bloomberg's coverage at Davos.
Do you think there's one particular thing that you'd like Trump to change in terms of what some people see as the over-regulation of banking in America?
I don't believe, honestly, that we should have a huge amount of deregulation for larger banks. I think that's, you look back at COVID and any crisis, big banks now are strong, are able to step in and being part of resolving issues rather than being the one that creates issues. So I wouldn't really welcome a huge wave of the regulations. What I can see is that, of course, what happened in the US doesn't mean automatically that you will see in Europe or in Switzerland or in Asia deregulation. So the fact is that US banks may become even more competitive internationally through a more benign environment.
Nobody covers Davos like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Yields lower in the bond market. We're down by about 2 basis points at the moment. The 10-year 448.18. Under surveillance this morning. Calming words for fixed income. What is the medium term? And then once you see all those things, let's say those ambitions become reality, then do you start to think about terming out the debt?
Sure, but that's a long way off. And we're going to see what the market wants. The Fed said that they may stop their balance sheet runoff. So, easier for me to extend duration when I'm not competing with another big seller. It's going to be path dependent.
So here's the latest. Treasury Secretary Scott Bessent looking to fight inflation, saying any move to boost the share of long-term treasuries is a long way off. Kelsey Barrow of JP Morgan Asset Management writing, the biggest risk for the bond market is a sustained reacceleration in inflation and wages that result in rate hikes being considered. A Fed on hold is still a positive backdrop that supports fixed income. Kelsey joins us for more. Kelsey, good morning. Good to see you.
Good morning.
What did you take from the Treasury Secretary's comments on terming out the debt?
Yeah, so I think the bond market was encouraged by the message from Secretary Bessent, which was that it's not the time to be terming out the debt, which I think really makes a lot of sense, right? If you look at the yield curve, it's positively sloped. If you look at 30-year real yields, they're at the highest level in 20 years. This is not the time to be terming out the debt. And so the bond market is comforted by the fact that there's somebody at the helm that understands the supply-demand dynamics and is looking to manage term premium and at least not aggravate term premium even further.
You're concerned about inflation, though, and potentially that means the Fed is either on hold or might have to weigh a hike this year?
No, so the biggest risk for the bond market is inflation, but we actually feel fairly comfortable with the inflation backdrop. And we do feel like with the Fed, they are still in an easing bias where there are essentially 2 decisions at every meeting, or 2 options at every meeting. One of them is to stay on hold, which is where they are right now. The other is to cut rates. And I was hearing in the earlier segments a discussion about the labor market, monitoring jobless claims, looking at the impact that the layoffs are going to have on the broader economy. We still believe that the Fed is much more sensitive to labor market weakness than they are to labor market strength. You get a strong report, the Fed does nothing. You get a weak report, the Fed is stepping back in to support the economy. That's generally an environment where yields are range-bound with some risk of moving lower.
Well, to that point, long-end bonds, they've fallen by about 9 basis points so far this year. There's this discussion, how much of it is supply, what we heard from Scott Bessent yesterday, and structural changes that may or may not happen. To you, what is the bigger driver of that? Supply, or is it growth concerns we're starting to see in the long end?
I think it's primarily growth concerns. I think supply is a secondary factor. And the one thing that I would highlight is, while the Treasury Secretary does have control over where we issue on the curve, and they're in charge of determining what the weighted average maturity of the Treasury's debt is,
they are not the ones ultimately responsible for determining how much debt needs to be issued. That's still a function of how much the government takes in. So that's how much revenue they get from tariffs and taxes versus how much they spend. That's what the Congress is debating right now in terms of the reconciliation bills. That whole, in the end of the day, it is not something that the Treasury control, but ultimately is a function of what the Congress decides. And so what the bond market is ultimately going to be trading off of in the long end is what that growth impulse is or is not as it relates to the fiscal trajectory. Do we get the tax cuts, the extension of tax cuts? Is there room for anything else, or is it really just status quo? In that case, not a lot of impulse coming from fiscal.
You explained the Fed's asymmetric reaction function. I want to understand how the Fed would respond to the following scenario. Let's say we got some weaker economic data. Labor force data started to soften a little bit, but they still face the prospect of a real policy change further down the road. I think what we're all trying to gauge in markets is whether that asymmetric reaction function would be compromised by the prospect of policy change further down the road.
I don't think so. I think that they are aware that there's a high level uncertainty, but they don't want to hamstring themselves with the what ifs, because there's always what ifs. We never know what's coming next. And in fact, perhaps we actually know a little bit more than we did before as it relates to what the Trump administration is trying to achieve. So I think they're going to stay very focused on the data. They're going to stay focused on the labor market, which for now is still quite healthy. And then on inflation, which, you know, I think this year the Fed is much more prepared for the January inflation heat. The bond market has done a very good job fading the extremes, right? So you had a weak retail sales report. The market brushed that aside because we know that the consumer is fully employed. They're going to keep spending. On the other side, we had the strong CPI report. They also brushed that aside because when we know that January continues to surprise to the upside, no matter what the economists are trying to do to seasonally adjust it doesn't seem to be working. And if you look at PCE, which is the Fed's preferred measure, we're expecting that to fall to 2.6% on a year-over-year basis. 3- and 6-month run rates around 2.5%. Yeah, it's not 2%, but it's pretty close.
There's a lot of what ifs, that's for sure. Spending cuts, tax cuts, March 4th, 25% tariffs on Canada and Mexico. Middle of March, 25% steel, aluminum. April, 25% autos, chips, and drugs, maybe more than 25%.
Lumber, allegedly, according to the president the other night, and also April 1st, before the April 2nd deadline he set. April 1st is when the team is supposed to come together and say, this is where the issues are on these countries, on these sectors, and this is what we need to do. And at that point, he'll have Jameson Greer in place.
And towards the end of March, the Federal Reserve's got to put out some forecasts, so good luck to him. Kelsey, it's good to see you, as always. Thanks for dropping by. Kelsey Barrow there of JP Morgan Asset Management. Up next, in the second hour of Bloomberg Surveillance, we'll catch up with Aaron Kennan of Clear Harbor Asset Management, Dan Clifton of Strategas, Edward Fishman of Columbia University, and the former chair of the Council of Economic Advisors, Jason Furman. Equity futures this morning just about unchanged on the S&P 500. Live from New York, this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period,